made possible by the support of our sponsors and hosts, and we owe each of them a considerable debt of gratitude, not just for their support in making these days possible, but also, and just as importantly, for the participation that of their staff and principals that they make available. It's that commitment of time and thought and support that we really value in trying to improve the way in which managed accounts are understood and operated in Australia. Today we're going to have a fascinating overview of the asset classes which you'll be considering in constructing portfolios. And I'll sort of touch briefly on some of the sessions that we'll be focusing on today. We're going to start off with a focus on global equity investing, both with Bell Asset Management and the SMID sector, and then immediately talking about the role of factors with S&P and Global X, and how each of these influences the way in which a critical part of the portfolio is put together. We'll be considering then the oldest commodity, closely related to the oldest profession, but perhaps of greater longevity. You'll all be leaving here, by the way, with a sample of the sponsor's fine product, courtesy of the World Gold Council. At least an ounce each. And then we'll consider impact investing and the current state of interest rates. So over lunch, we'll then look at, not at the sort of conceptual approach to portfolio construction, but actually with Milliman's, we'll be looking at how portfolios are actually being constructed. So we ran a survey, which some of you will have participated in, looking at the actual asset allocation of the balanced portfolios. And Milliman's will be taking us through a sort of a deep dive on what does Australia's advice community think a balanced portfolio ought to look like. How might those portfolios perform in times of stress, a time which we could be heading into, and we'll also be engaged in a bit of table discussion there, because one of the other questions we asked was, what are the things which, as a portfolio constructor or advisor, you're worried about, you're thinking about? And we got some answers from the survey, but it's something which we can talk about amongst ourselves as well. We got some very interesting answers to that in the Melbourne equivalent of this session. We're going to finally finish with a presentation by Alan Kirkland, the Asset Commissioner, on their approach to the managed account market. They have convened a project team to address managed accounts, and he and I will be talking about the issues that concern them and what has driven that project team. There's a lot going on in the regulatory environment for managed account advisors, portfolio managers, licensees, product issuers, more than I can recall in a single year for quite a long time. And on the screen, you'll see 4 of the regulatory issues that I think will affect the way in which managed accounts are offered and advised on. ASIC's corporate plan says that they will focus on those AFSLs that recommend or offer managed accounts, and they will concentrate on governance frameworks, management of conflict of interest, and outcomes for consumers. And so Commissioner Kirkland and I will be talking about what they actually mean by those 3 issues. In the session, we'll unpick what they mean by all 3 of those phrases. In 2026, IMAP will be running workshops specifically focused on governance frameworks, on the management of conflict of interest, also on AML and CTF, because as you'll all know, the law has changed in respect of that, and the the operating models for different types of managed accounts give rise to different obligations in respect of AML and CTF. We'll also be running some workshops to address the changes to the way in which conflicts of interest have to be managed as a result of the changes to RG 181. ASIC released a new reg guide in draft. It flew below the radar for a lot of people. IMAP put in a submission on that conflicts reg guide, but I didn't see a lot of coverage of that. But the implications, assuming the draft goes through unamended, and I think that is what ASIC intend, the implications are quite significant particularly for managed accounts, particularly in managed accounts, SMAs and MDOs. Most importantly, perhaps for some of the people in this room, certainly for me, the MDA class order is a class order. They expire and need to be refreshed every 10 years. Next year's the year. So the law underpinning the operation of MDAs could change materially, or as in 2016, when we were similarly involved, it could go through relatively unamended. My instinct says not. We have already convened a working group for that. And I wanted to call out Jenny Mulders, who's the chair of our reg group, and Stephen Karash, who may be in the room, or Stephen here, who both Jenny and Stephen have been working with us to draw together that MDA class order. Look, all the materials that you see today will be available to you on the app. There's a QR code on the screen. There's also a QR code, same QR code on the front of the agenda. All the materials, the speakers' biographies, all available through the app. It's now my pleasure to introduce our first presenter, Ned Bell. Ned is the founder, CEO and CIO of Bell Asset Management, a global equities manager. And he's going to kick us off today with a discussion on the opportunities in the SMID sector. Ned, welcome to the stage. The green button goes forward. Green button.
Good start. Welcome. Thank you very much for having me here today. So, global equities, obviously we're at a pretty interesting point in markets. We've had a massive, the markets have been incredibly strong. The AI boom's been incredible. But I thought what I wanted to do today was just try to give a bit more perspective across other areas of the market. You've all probably heard 1,000 presentations on the wonders of the Mag 7, but there are other opportunities. And I think we're at a point in the market now where I think as advisors, consultants, you need to start thinking about where you can diversify, the changes that you can start to potentially make to client portfolios. So the things I wanted to really drill down on today was, a lot of the questions you would have. Will the Mag 7 continue to drive markets for the next 5 years? Are there some areas that you should start to rethink? Are there some changes you can potentially make to portfolios? I want to drill down also just on some of the style volatility we've seen, which has been massive, particularly in the last 12 to 18 months. And then where you can find different opportunity sets. And the opportunity sets are quite different. I just encourage you to try and broaden your horizons a little bit, because there are other areas of the global equity space that they're actually doing very well, but they're completely ignored. And then lastly, I'll come back to sort of the global small mid-cap opportunity, which is an area of the market we have a big role in. And I think that should be a much bigger part of portfolios. So just thinking about, I'll touch on the Mag 7 quickly. And again, this isn't a beat up on the Mag 7. We've got exposure to it. But we are at a pretty interesting point in the market where they are at a point now where growth has obviously been exceptional, as we know, but it is slowing. And that's something that I think everyone's just got to pay a little bit of attention to. If we think about sort of those 7 names, the earnings growth into next year, 4 of those 7 names, the earnings growth is going to be sub 15%. So that is quite a bit lower than what it has been in the past, yet valuations are very, very high. So that's always a bit of a canary in the coal mine for growth stocks, is when growth slows and multiples are at their highs. And we obviously saw in the deep-seek sell-off a couple of months ago, is that when the market catches a cold, these things can come back, very, very sharply. And again, I'm not trying to beat up on Mag 7, but the risks there now are much higher than what they were 6 months ago. And so I just think that's something we've got to think about. Obviously, the contribution, the index contribution of the Mag 7 has been massive. So over 5 years, 7 names have accounted for 30% of the returns. 30%, it is quite extraordinary. I don't think we've ever seen that, even back in the dot-com boom and bust. So just some things to sort of think about. Again, I just want to flag some ideas and some changes that you can potentially think about with global equity portfolios. Active management's been terrible for the last couple of years, as you all know, but I think that that has sort of got completely out of whack. Quality as a style has been, has obviously been pretty poor more recently, but again, that's got out of whack. Try to position portfolios for more market breadth. We are seeing more market breadth in markets this year, but I think that's got a long way to run out. Reducing exposure to Australian equities. I manage Australian equities also, and it's very, very difficult, frankly. And look for other areas like Europe, Japan, what I call the S&P 493, the other 493 stocks in the S&P 500. There's some really good companies there that have done really well, but they don't have enough representation in portfolios. And last but not least, come back to small mid caps. And again, anyone who says this time it's different, put your fingers in your ears, ignore what they say, because that's never true. So first of all, and apologies if this is going to come across as death by 1,000 charts, but what I want to point out here, so this is looking at the MSCI World. The chart on the left shows the MSCI World Index performance over the last 10 years. And so the white line is just the performance of the index. Is it up there? Next one. There we go. Oh, they're a bit out of whack. There's not something there anyway. So I didn't even rehearse that. But you can see that on the left there, so that's the MSCI World Index. The blue is earnings, the red is valuation expansion. So the returns are some combination of that. And obviously for 10 years, the earnings have done a lot of the heavy lifting, and a lot of that can be attributed to the Mag 7, which you all know. On the right-hand side, this is where it gets a little bit scary, because the last 2 years, more of the performance is coming from just valuation expansion. So this is a bit more fear of missing out. The same thing did happen in '99, where the growth is slowing, but the multiples continue to expand. And so that's just sort of something that, again, it's not trying to scare you, but we are getting a little bit later in the cycle. And again, that's a risk I think we've all just got to be more aware of. Looking at the, again, this is looking at, I'm just scared to walk past that mic now. This is more getting into active management. And so this looks at the percentage of strategies that have outperformed over certain time periods. So in the middle there, you can look at, so these are global large cap strategies. And again, I think you already know this, but if you look in the last 5 years, you've only had 30% of global equity strategies have outperformed in the last 5 years. A lot of that is due to the Mag 7 or lack of exposure or lack of management. But in the small mid-cap space, that hasn't happened. The actual percentage of managers still outperforming has been very, very high. So again, if you think about where you want to allocate your active strategies, having more in SMID does make sense. But I also do think that the large cap allocation, that's poised to rebound quite a bit. And that always does happen. When the Mag 7 does come back, you see more and more strategies outperforming. So again, active management it's bruised, but it's not dead. And then this is my least favorite chart as a quality manager. So you've seen some pretty wild performance in factors in the last 12 months and the last 18 months. On the right-hand side, that yellow bar, that's the Goldman Sachs non-profitable tech index. So if you completely ignore fundamentals and valuations, you've absolutely nailed it. On a year-to-date basis, that chart is actually up about, it's actually up about 58%. This does remind me a lot of 99, 2000. I was working in San Francisco for a fund manager in 99, 2000. I saw this and again, this starts to get pretty late cycle. And then you've also seen other areas of the market like, you know, the cyclical stocks that rallied in advance of, you know, interest rate cuts, what that's going to do for growth. And then, you know, the growth area of the market, again, more recently, that's been more multiple expansion. The growth has been good, but it's becoming a lesser part of the returns. And then quality's lagged. The fundamentals are fine. You're actually still seeing earnings upgrades, but it's the only area of the market where you've seen multiple compression. So I think as the point I'm trying to make is that it's a good opportunity time to allocate back to quality because the fundamentals aren't necessarily sort of suffering. Again, this tells a similar message through the prism of the small mid-cap universe. So you've seen what I call the junkier ends of the market. So whether it's bank or cyclicals, they've done incredibly well. You know, a lot of them in Europe have done incredibly well, but again, the stocks have probably run ahead of earnings. Again, it's a lot of multiple expansion and sort of speculative investments that have run those sectors up. This is a bit scary, this one. So this is looking at quality within the prism of the S&P 500 index. And what it shows is that, you know, right now, quality stocks are at a point. Now, the last time that underperformed by this much was literally 99. Was about 3 months before the dot-com boom and bust sort of imploded. But it also highlights the fact that if you're brave enough to lean in on quality, when it has lagged, it can rebound extremely strongly. And again, if you did that back then, you would have generated about a 30% return in the subsequent sort of 18 months, just by leaning in opportunistically buying quality. So that's a little bit sort of on style. When I think of Australian equities, I just think hard work. This is an area of the market that I think you need to think about if you haven't done so already. Try to reallocate away from potentially Australian equities. Again, I've been investing in them in addition to global since 97. And I've never found it harder, frankly, to find good things to invest in. As we all know, you know, the opportunity set is somewhat limited. The massive size of the super system has made it difficult to, you know, that's inflated multiples. So that's made good quality Aussie stocks look extremely expensive versus their global peers, which is not great. And, you know, if you think about what I've called the yesterday's heroes, you know, the great companies that have generated great returns over 10 years, they're not necessarily doing what they did in the past. And there's not a lot of companies that are taking their place. And if they are, they're very, very expensive. And some of the better companies, whether it's, you know, I mean, CBA trading on a massive premium to JP Morgan just doesn't make any sense. CBA is a good bank, but it's not that good. You know, Wesfarmers is, last time I looked, was 34 times earnings. The multiple is almost double that of Home Depot. So it is tough. Like, I mean, I find the Australian market very, very difficult at the moment. So again, I think you tend to look for opportunities to allocate away from Aussie. You know, when it comes to dividends, there are actually other areas of global equities where there's good dividend growth, and I'll get to that. A couple of them. So if we think about Japanese equities, so for my sins, I've been looking at Japanese equities for about 30 years too, and that's a pretty long wait waiting for them to work. But they are finally starting to work quite well. And what you've actually seen is that the performance in Japanese equities have been really good, and the earnings growth has actually been staggeringly good. And the chart on the left-hand side there shows that the returns have mainly been driven by earnings growth. So that the blue part of that chart on the left is showing that, again, earnings growth has been exceptional. And what's happening in Japan is that a lot of, like, the government, the stock exchanges, the regulators are encouraging companies to improve their corporate governance. So they're buying back shares, they're paying special dividends, they're improving their return on equity, and all that is driving what's actually really, really good performance. So Japanese equities are, you know, really interesting area of the market. I was looking at this morning, but the earnings growth from 21 until this year has been about 36% versus MSCI World of about 25%. So Japanese equities have actually outgrown the global market, notwithstanding the incredible performance of the Mag 7. But again, it's not like it's most global investors are very underweight in this area of the market. And in a way, I think about this as being like an area of like defensive earnings growth. It's not all coming from top line, from like revenue growth. A lot of it's just coming from basically companies improving their balance sheets. And if you look at the size of the size of the share buybacks, that chart in the middle, so that's equivalent to, I think it was $130 billion of share buybacks announced this year, which is equivalent to 3% of the Japanese equity market. I mean, that's a remarkable underpinning. And again, to my point earlier, the dividend growth has been really good too. So again, that's an area of the market that's we think is really interesting and not really appreciated that much. And they're not that expensive too. They trade on, it's about 15 times earnings, Japanese equities. US equities trading on about 22. So again, they're not that expensive. You don't have that same valuation risk that you've got in other areas of the market. European equities, so as Anthony would tell you, like when I was presenting probably early last year and I was talking about being overweight European equities, I'd have to put up the chicken wire because they were incredibly out of favour. They'd lagged terribly, but they were some of them were very inexpensive. And it was more on the basis we could find really good companies in Europe that were just completely, they were just very undervalued. And more recently, you've actually seen this phenomenal recovery in European equities. And there are some very good companies there. And again, the chart on the right is showing you that it's mostly earnings doing the work. It's not valuation expansion. It's earnings are really driving the markets. So again, it's an area where I think people, when they think about global equities, they have a hard time moving away from the Mag 7, but there are lots of opportunities. Again, like Japanese equities, they're cheap. They trade on about 15 times earnings. From what we've seen, the earnings growth is probably looking like about 10% annually for the next 2 years. There's probably a bit more upside to that. So again, it's an area of the market we think is pretty good. I mean, the chart in the middle, all that shows is that, again, it's just that the valuation's not doing the heavy lifting. The valuations have expanded a bit off extreme lows, but there's still room to move. So this is what I call the S&P 493. So this is every other stock in the US, S&P 500 that doesn't get talked about, but has actually delivered really well. There are some fantastic companies there that I think, people need to think about getting more exposure to. They account for about 65% of the US equity market. They trade on collectively, they trade on about 10p point discount to the Mag 7. So much less valuation risk. And 64 of those names have actually outperformed the Mag 7 over the last 5 years. So there is a lot of, there's a lot more breadth within the US equity market than I think people realise. And some of those names we've had exposure to. They're not all tech stocks. Boot Barn, sells boots in Texas. You've got some pretty weird companies there, but they've done pretty well. Dick's Sporting Goods has been that's been a phenomenal sort of retail story. Oracle, we've had exposure to things like Arista and Oracle, so Broadcom. So there's definitely some tech exposure there, but it's not all tech. And then on the right-hand side, you can see that there's a lot of companies that are just incredibly consistent. So we all know Costco, TJX in the retail space. Rollins is the most boring company you could think of. So they're in like pest control. So a colleague and I went and met with them about 8 years ago in their office in Atlanta. It's very boring, but it's very consistent. And they generate about a 25% return on capital. So again, it's a great business in a boring industry, but it compounds incredibly well. Zoetis is the old healthcare business that was spun out of Pfizer. It's much better treating animals than people, far less regulatory risk. And so there's some terrific businesses in there that, again, can play a really important role in portfolios that I think you should just think about ways you can get more exposure to. So that's the S&P 493. And then getting to, so those are a couple of like geographical pockets of opportunity, just to sort of think about. Now, I want to sort of pivot to like another one, which is the global small mid caps. So global small mid caps, just to put it into context. So this is the MSCI defined as the bottom 28% of any market. So it's ballpark the bottom third of global equities. And again, most portfolios have got very little exposure, but it's an asset class that has actually,
over a very long period of time, it's done very well. It gives, and the way to think about this is, I often get asked, how does this fit? How does it fit in the portfolio? So first of all, it plays a growth role. It can complement, so, like large cap growth, emerging markets, Aussie small caps. So, and the way I'd contextualize that is there's less valuation risk than large cap growth. There's less absolute risk than emerging markets, which is a low bar to jump over, but that's true. And I think a better opportunity set than Aussie small caps. Aussie small caps are, hard work to find really good quality, to be honest. And they should continue to sort of grow. They've grown earnings actually really well, notwithstanding the fact they have lagged a little bit more recently. And then I think the other point being is that donut chart there just sort of shows that it gives you really good geographical and sector diversification. And I think that's important. So the growth is coming from industrials, it's coming from financials, it's coming from the consumer sector. So it's not just tech. So it does tend to complement a large cap global portfolio really well. Again, over 25 years, it's been a really, really good performer. And that shows that in the last couple of years, it hasn't outperformed, but the earnings have. So the earnings growth has actually been better than most other areas of the market, but they've not had the benefit of the PE expansion that comes with that, with passive investing. But the stocks have done very, very well. It's been a great asset class over 25 years. So again, so sort of thinking about sort of the growth factor, because that is the role that it plays. It plays a growth role in portfolios. The charts on the bottom just show that from a historical and a forward-looking basis, the asset class, it has outgrown on an earnings level and a sales level, and it should continue to do so going forward. That chart on the top left, I just sort of, like if you think about where a lot of portfolios are placed on that curve, as Mag 7 exposure becomes a bigger part of portfolios, basically more of your portfolio is moving towards the pointy end of that red arrow. In other words, you've got more exposure to companies where growth is starting to roll over. That can be quite dangerous because that's when you get more in the vicinity of multiple expansion. So making an allocation to small mid caps is more about allocating to those companies that are they're past the startup phase, but they're earlier on in their growth trajectory. And that's really the role that it plays. And that's frankly where you make the most money, when growth accelerates. And that's the role that sort of smalls and mids, can play in portfolios. They're cheap. They're cheap. They're just not nearly as expensive as just about anything else you look at. And interestingly, I was looking at something the other day that looking at the earnings growth of small mid cap stocks versus large cap peers basically from the COVID lows. And small mid cap stocks outgrew their earnings, outgrew large cap stocks by about 15% from the lows. And so what they did, they actually cut a ton of costs and they took a lot of debt off their balance sheets during that COVID period. So they've actually outgrown earnings, but they've underperformed because they haven't had the multiple expansion. So again, and that's obviously relevant because market valuations are very expensive. They've picked up a lot. So again, you're mitigating valuation risk, by making an allocation there. The catalyst, I always get asked, what's the catalyst? The catalyst comes down to a couple of things. So it is the fact that looking into next year, earnings growth, again, will be better than the large cap peers, and it's starting to accelerate. US small mid caps, you'll start to see some effects like demand start to come back as a result of interest rates being cut. The consumer in the US, and obviously we've had tariffs, but there's been a lot of, I call it White House noise that has kept a lid on the economy per se. But I think that will start to mitigate and sort of start to trail off into next year. So there's a good argument that as the earnings start to inflect, that will be the catalyst for the asset class to start to work really well. Here's an example of just some of the companies we own. I mean, I call them the best companies you've never heard of. But collectively, I mean, they are very profitable. And I think this is another thing. A lot of people, when they think about small mid-cap stocks, they think about companies that are much earlier on in their growth trajectory. They're still burning through cash. raising capital, that's not necessarily the case. There are some fantastic companies in there that are past that adolescent period, but they're generating, I mean, these companies collectively generate a return on capital of 26%. They've got no debt, and they've grown earnings at 16% a year for the last 5 years. And they traded on a free cash flow yield of 4%. So they're not incredibly expensive. And then from a size perspective, the average market cap's it's about 25 billion. So they're not tiny. So global small mid caps, they are much bigger than what we find here in Australia. So you don't have that liquidity risk that you would find with small caps in Oz. And then when I think about sort of like these are some of the names that have, we've owned that have done well over a long period of time. And again, it's a broad array. It's not just US tech companies, it's companies in healthcare, financials. Again, a lot of European companies more recently, surprised some, but we've had things like the Hong Kong exchanges, which has been a phenomenal performer recently, Euronext, Deutsche Börse. So again, you're getting performance from areas outside the Mag 7 that are a bit more, they're not as correlated, and I think that's really important. So it's an interesting opportunity set, and again, I think it's something that more and more investors are starting to lean into, but I think it needs to be a bigger allocation in a lot of portfolios, and now's the time to really do it. So again, sort of just thinking about some of the catalysts, there is a lot there. I think thinking about some of these now, easing geopolitical tension. I mean, that might be wishful thinking, but it will happen one day. And the tariff uncertainty has obviously gone on for a lot longer than what we thought. But actually, just on that, I think another point I didn't mention was that if we think about CapEx spending in the US, a lot of that has been delayed in probably the 3-month period before the election, but that does need to start to come back to life next year. So I think that's another important catalyst. And in many ways, a lot of the US small mid caps are beneficiaries of tariffs because they're being protected from peers offshore. So there are some actual beneficiaries. And I looked at, there was a stat that showed that I think it was the Russell 2000, the average domestic revenue was about 85%. So they're quite domestic US companies. They don't have the same tariff risk that Apple or other companies would typically have. M&A activity is starting to finally come back to life. And again, I think there's a lot of catalysts there. So to sort of summarize, I think the main message I'm trying to get across is I think now is a time when you should start to think about changes you can make to allocations. There's a lot of opportunities just outside the Mag 7, and Mag 7's been great. We've got exposure to it, but it's not the only thing to have exposure to. And I'll just encourage you to sort of broaden your horizons a little. So with that, I'll come up for air. I think I'm going to take some questions.
Thanks, Toby. Thanks, Ned. Insightful. A quick question. With the next 493, a lot of the issues, you talked a lot about US and other opportunities, but in the US, of course, you've seen, tariffs change, and a lot of these companies, how exposed are they to importing goods or services to deliver to their clients? And therefore, what's the potential impact of, these newer tariffs in the US marketplace?
Yeah, it's a really good question. I mean, the short answer is I think they've all got, a lot of them have got exposure. So if you think about, Nike, for example, anyone in the textiles industry, that's definitely an exposure. However, a lot of those companies since COVID have diversified their manufacturing bases outside of China to Vietnam and other countries. So it's less of a risk than what it was. And I think the other thing is that, so when you think about how do you get out of the crosshairs of Mr. Trump, you turn up to the White House and you promise to build a big plant in Alabama that will, and I'll start doing it in 4 years' time when he's gone. So I think a lot of the companies have sort of, the playbook is becoming a little bit better understood. And I think the other point I'd make is that I think the question is like, when are they feeling the maximum earnings pain? And it's really this year. This year is when they're feeling the pain. I think going into next year, it's probably that's when you start to get a bit more of the recovery. I mean, I think the reality is that, and Trump had a pissy fit the other day and threatened another 100% tariff on China and then reversed it within about 30 minutes. So I think he realizes that the actual economic effects of these tariffs is a lot more significant than what he had acknowledged some time ago. So I think I think we're past the worst in a nutshell. Sure.
Yeah, Rob? Yeah, the valuation charts that you put up about SMID versus, the global markets were really interesting.
Yep.
I'm wondering how that might, that one
Yep.
might look when you take out the Mag 7 and the equivalent of those kind of stocks in Europe and Asia.
Yep.
Does the SMID become a proxy for just the ex-Mag stocks, or is it still cheaper relative to those? Comparison?
In a way, it does. Yeah. So if you look at the valuations for the valuation differential between, say, the equally weighted MSCI index and the SMIDs, it's not that different. However, you have seen, but SMIDs are still cheaper, and the gap has opened up, and that's partially because in the last 12 months you've had a lot of large cap European banks, for example, US banks have actually done very well. So the equally weighted index multiple has actually expanded a little more. And I mean, frankly, so it comes back to why has the multiple expanded so much? A lot of it is to do with passive investing. What we saw when we saw the DeepSeek sell-off, the Mag 7 all dropped within about 0.5% of each other over 2 or 3 days. And that's just telling you it's passive selling. So I think the valuation gap is still really, really compelling, if you like, but it all comes down to the catalyst, right?
Yeah. Thanks.
Sure.
Ned, what's the role of thematics like artificial intelligence in your stock selection process?
Yep, it's a really good question. I think thematics for us tend to so again, we're a quality manager. We screen for companies with great profitability and growth and balance sheet strength. The thematics have a way of emerging through the process. What we don't like to do is say, like, we've got a thematic on AI and therefore we're going to find the best fit. I mean, that's a great way to get into trouble, frankly. But the likes of NVIDIA, Broadcom, I mean, 6 of the Mag 7 screen extremely well for us. So our process takes us there anyway. But it also steers us away from, like, there's peripheral AI themes, for example. So so whether it's in private credit or whether it's in, there's a lot of these companies in the US that are like the HVAC air conditioning companies that are putting air conditioners on data centers. I mean, that's really stretching it. I mean, our process will probably steer us away from those. So I think you've got to be really aware of the thematics, but you've also got to be aware of the crowding effect in those names. I mean, like the AI theme is like, you can't be so skeptical that you're not going to invest in them, but you have to understand how these things are owned. And the DeepSeek sell-off was the lesson in that. So if you look at the register of whether it's NVIDIA or Broadcom, and we own these names, but the percentage of ownership from growth managers and also from mum and dad investors has exploded. So you've got to be very cognizant of that. And it's not about being a non-believer in AI. It's just recognizing that the enthusiasm around some of the thematics, it has to happen when it turns, the multiples tend to drop pretty quickly. But I think and it's not just an AI conversation, but it's also, I think, again, I mean, our process sort of tends to steer us in a certain direction. So, for example, now, if you think about like I had them up, some of the highest quality low beta stocks in the world, like whether that's Costco or, I mean, Procter & Gamble is considered incredibly boring, but it is a very low beta stock, and a lot of those names are very, very inexpensive. Like very inexpensive. And again, coming back to 99, when the dot-com boom busted, like everything that worked, it was healthcare, it was Staples, it was Costco, it was all those sorts of companies. So again, our process tends to steer us in that direction, as it does with Japan. So Japan I consider that to be a thematic. We've got more Japanese companies that pass our initial filters now than has been the case in 25 years. Like in 25 years, like that is quite amazing. I mean, I'd say 5 years ago, there was probably only a dozen Japanese companies who would screen. Now there's about 60. And again, it's this improvement in return on equity that's really driving it. So the themes are, we don't like crowded themes. We like themes that are not picked over. And often when I apologize to any Americans in the audience, but like when I go to the Japanese conferences, if there's no Americans there, I'm like thrilled. I'm like, I know I'm not too late. Sorry.
One American in the room.
One, sorry.
One. um, So Carl with the microphone. Yeah. Yeah, there you go.
Does currency have to be factored into some of the investments that are going overseas? Because you're talking about mostly overseas, the US and Japanese and Europe.
Yeah.
So currency has in the last little while been a factor from an investment point of view. So
Absolutely.
is it longer too?
Currency is always an important factor, I think, with global investing. And I think for anyone who's prepared to put their foot into global investing, they have to accept that as a risk. But what I would say is that in many cases, there's a natural currency hedge. So if you're investing in Apple, for example, you're buying US dollars to buy Apple, but they're selling, more than 50% of what they're selling is outside of the US. So there is a natural currency hedge, but it's delayed. But then when it comes to things like Japan, you've got to be very cognizant, but you can be very opportunistic too. In that, for example, we've just started a position in Recruit, which is the owner of Indeed. So the yen's obviously, been very, very weak. So we've had the opportunity to opportunistically buy cheap yen at the time when Indeed was also out of favour. The currency hedge is a bit less prevalent in small mid caps because they're more domestic UK, domestic US, domestic Japan. But you've got to be very conscious of it, obviously.
Keep on time. Please join with me in thanking Ned for a really insightful.
Thanks, buddy. Appreciate it. Thank you.
A great start to the session, and if the Texas boot market is something that's right there doing it for you, Ned's given us that extra highlight. So look, our next session really picks up on some of the issues that came out of Ned's presentation. We're now going to have a panel discussion and presentation on global factors, and I'm delighted to be joined today by, I think, the only American in the room, Julie Ballard, who's the director with S&P. Her colleague Jason Yee, director for factors and dividends from S&P, based in Beijing, and Chad Heitzman, who's head of institutional sales for GlobalX. Julie, welcome.
Good morning, everyone. It's great to be here, and hello to those joining us online. And I thought I was going to do the very brief intro for my panelists here, but Toby's done that very well. Jason, as Toby has mentioned, is our product manager for factors and dividends. I know normally we do group factors and thematics, but I think his title really reflects the demand we're seeing from the Asian market for dividend strategies. And Craig, I know, Chad is a very familiar face to the IMAP crowd. And I have to say, IMAP could not have done a better venue selection. You can literally walk across the street back to your office today. We will start with 2 brief presentations. We're going to start with Jason first, followed by Chad, and then we will have about a 10-minute discussion, and we'll open up to questions from the audience as well. I'll let you start, Jason.
Thank you, Judy. Yeah, I'll just stand. And good morning, everyone. Actually, I cannot see my slides myself. Okay. Good morning. So I'm Jason Yee from S&P Dow Jones Indices. As Judy mentioned, I cover factors and dividends. mainly, the strategies or indices that comes with a bit of like, active, well, nowadays active passive is quite blurry, right? With a bit of like active strategy behind the traditional, you'll think of like broad market cap weighted indices. And for those of you who might be less familiar with the factor world, maybe I'll start with, defining what are the factors. Well, we just have a nice breakfast in front of us. I think of factors as like the basic nutrients that in our daily diet. If you think about, the food that we eat every day, what our body really needs are the nutrients. It's the proteins, the fats, the carbohydrates behind those foods, right? But then you can think of this each plate in front of you is like a portfolio. You have a diversified portfolio, and what you're really getting behind your portfolio returns, those systematic driver of the performance, these are the factors. These are the sources of the drivers in terms of your portfolio returns over the long term. So that's how to think of like visualize the factors in terms of like an analogy. What's driving the factor growth? If you think about the global ETF space today, on the ETF side, factor ETF is probably $2 trillion of assets, depending on how you classify them into the group. But over the past 20, 30 years, we saw that this group of, factor-based or smart beta investing really kind of grow in the 20, 30 years horizon. And there's some of the theoretical background, and that's part of the thing I like about the factor investing. So if we take back to like 40, 50 years ago in the 1960s, 70s, when Harry Markowitz and William Sharpe, they came up with a capital asset pricing model. Back then, for active manager, they can tell you like, this is my portfolio return, this is my brilliant strategy. It's very difficult to understand where that performance comes from. The CAPM model tells us that, well, you have something called the market beta, where you are taking the market, exposure, you are compensated by taking the market risk. And on top of the market beta, you have this excess return, so-called alpha. And that's our understanding of like how to look at active management in like 40, 50 years ago. And then move forward in like 1980s, 1990s, there are a lot of financial literature that came up talking about, well, CAPM is not a perfect model. It's not a great model, in fact. There are things that CAPM just cannot explain in terms of return differentiations. And there are researchers, like Professor Farmer and French, they come up with like, 3 factors, 5 factors, and there's a worldwide research in terms of nowadays, like we call factor zoo or factor walls. But what really it tells us is that on top of the market beta, you have other factors or smart betas that are giving you some of the systematic exposures, and as a compensation, you are getting some of the excess returns. So what you can look at is that it squeezed the traditional so-called alpha to a higher level. So some of the traditional alphas that people think about in the 70s or 80s, now when you look at from the factor model perspective, the manager is doing nothing but having some exposure to some momentum stocks, to some value stocks, to some quality stocks, right? And those are very commonly researched factors. And what you can do is that, well, factors, they can be easily kind of created or published through an indexing approach because these are rule-based systematic ways of constructing a portfolio. So as we can construct factor indices, the ETF issuers can use factor indices to package them into the ETFs, right? Which is, again, a low-cost systematic rule-based approach. So now, instead of paying a traditional active manager a quite expensive fees, you can get some of the factor exposures in a relatively cost-efficient manner. And now what you really need to look at the active management side is that, well, if I control for the market beta, now the market beta is very, very cheap. On top of market beta, if I control for extra factor exposure like value, quality, momentum, what else do you deliver? Are you justifying the fees? And that's what we see, right? The growth of the factor investing, because you can easily get those, ETFs through factor approach, be it single or multi-factors. And at S&P Dow Jones Indices, we have been, frankly, like doing factor indices for more than 30 years. Back in the 1992 with the first kind of batch of factors, or we call style factors, the value and growth. And then we developed the single factors and to the multi-factors. Recently, we have been spending a lot of resources in terms of the GARP factor, growth at a reasonable price. And I'll talk about that a little bit more because it's just a very nice way in terms of blending a couple of factors together. And if you look at our offerings now, we have offer factor indices across different markets, different regions. In Australia here, Under our S&P ASX 200 umbrella, we have the single factor family, we have the S&P ASX 200 GARP, and also if you're looking at outside of Australia exposures, the developed market, we have a suite of developed market single multi-factor indices. And today I really want to highlight on the S&P World X Australia GARP Index. So GARP stands for growth at a reasonable price. Essentially, you are looking at the growth characteristics, but you're also considering valuations quality into the construction. And I can give you an example. This is how we can do this through an indexing approach. It's very straightforward. So first, your starting universe is S&P World X Australia. This is basically your large mid-cap exposure outside of Australia. And then within the broad markets, you start with a growth screen. So growth we define as 3-year EPS and 3-year SPS, sales per share growth. And you use that two matrix form a composite growth score. You select the companies with the top 500 stocks, in terms of the growth score. That's your first screen. So now you're left with the 500 stock growth universe. Your second screen is we look at something called quality value composite. So the quality value is defined as return on equity, leverage, and earnings to price ratio. So you have two matrices on the quality side, one matrix on the valuation side. And we combine them together, form something called a QV, quality value composite score. And within the 500 growth universe, you select top 250 by the quality value score. And your last step is you weight the companies by the float market cap times your growth score, and it's subject to some of the capping and diversification constraint. The index is rebalanced on a semi-annual basis. So you can see this is just a step-by-step of very straightforward kind of index construction and what it does to the historical performance. It outperformed the broad benchmark, the S&P World X Australia, by quite a big margin. If you look at annualized compounded return, we're talking about 2 to 3% per annual over the long term of the excess returns. And that comes with about 4 to 6% of the tracking error, depends on when you look at. So this gives you like a bit of, a strategy flavor on the GARP, but in an indexing approach. And in terms of performance characteristics, the GARP strategy, if we break down into like the markets into up and down, so the up is when the underlying benchmark is positive in the monthly returns, down is when it's negative. So it's more likely to outperform in the up market. So about 60% historically, and this is like over 20 plus years of the backtest, the GARP index outperformed the underlying benchmark. And when the market is down, it outperformed only about 48%. So it's a little bit more like offensive, cyclical. If you look at something like dividend, it's the other way around. Dividend is more likely to outperform when the market is down. It's more defensive. And this is just another one, if you look at, the index, how it's delivering its objectives in terms of the characteristics. So here is a monthly, it's a quarterly average of some of the characteristics like growth, so EPS, SPS growth. The GARP index did much better. They have much higher growth historical characteristics than the underlying benchmark. And also, if you look at valuations, the valuation on the PE ratio is slightly lower than the benchmark. And on some of the quality matrices, it had better ROE, ROA, and also the operating margin and leverage ratios. So overall, like the index designed for its, purpose for in terms of growth at a reasonable price. So just quickly conclude here. So what we talk about today, first, what are the factors? Well, the factors, they're really the drivers of the diversified portfolio returns. Think of them of your daily nutrients on your diet. And the growth of the factor investing over the past 20, 30 years, there is really a theoretical asset pricing model behind those in terms of moving from the traditional market beta exposure to some of the smart beta systematic risk premium exposures. And we use S&P World X Australia GARP index as an example just to walk through how to construct a factor-based index and what its historical impact looks like. Yeah, Julie, back to you. Thank you.
Thank you, Jason. And that was a very good overview. I was actually thinking if you are not doing your day job, you will make a great university academic.
Thank you.
Chad, I will hand on to you.
Okay, awesome. So I'm in the habit of diving right in. So let's dive right in. I'm Chad Hitzman, one moment, from Global X Exchange Traded Funds. This is going backward, not forward. One second. Okay, here we go. Am I going backward or
Yeah,
forward?
you're going backward. You
Because
want
it
to
looks
go
like it's
forward.
going backward, forward.
Yeah.
Okay. Wait one moment. It's going in circles, in fact, it looks like. Oh, you had additional extra slides.
Yeah,
Okay,
the appendix.
Jason, okay.
We do a lot of appendices.
Here we go. So I'm Chad Hitzman from Global X Exchange Traded Funds. Delighted to be here this morning. 2025 has gone by in a rapid clip. It's hard to believe. There's never been a dull moment, even on weekends when markets are supposed to be closed. So I'm going to carry on and take the baton from Jason in continuing a conversation on growth at a reasonable price investing approaches. So at Global X, we run two GARP strategies, one of which is over international equity universe, the second of which is over the domestic equity universe. So before we dive in covering GARP left to right, back to front, a bit of obligatory biographical background about who we are. So Global X, we're a global asset manager, roughly covering 900 billion in assets under management, US dollar terms, across ETFs, managed funds, private equity, venture capital, real estate, and so on and so forth. Here in Australia, however, we're specifically focused on exchange traded funds, and we're very multi-asset in our offering. It's always good to have a mind toward asset allocation. So covering off each of the buckets from international equities, plain vanilla, thematic, domestic equities. We're talking about factor investing as well. We cover income solutions in terms of covered calls, fixed income. And lastly, we cover liquid alternative diversifiers, principally in the form of gold. So Global X historically in Australia, we've been the dominant ETF provider for gold. We have about 6.2 billion in assets under management for that non-correlation tool. It's the purpose of gold to our mind's eye. Okay, so this is going to be a speed dating speed round overview. And I'm going to tee up the conversation firstly by providing a bit of lay of the land with respect to the equity markets, global equity markets, where they stand. And from that, I'm going to basically tease out an investment case for growth at a reasonable price approach. The first observation, one second, I think these slides are a bit different, in fact. Okay, that's okay. So, okay, there's a bit of a mismatch. So the three observations, just rolling with it. The first one is basically that you can find quality and growth stocks. So if you actually looked at, for example, quality factor being profit margins, growth and quality are neck and neck in terms of profit margin exposure, in terms of 20% plus profit margins. The other thing I was going to point out was that year to date, the style factor or factor that has proven to be the best performing is growth, followed by value, and then followed by quality. So growth this year has done around 16%. You've had value around 13%, and you've had quality around 11%. So basically from that observation, I was going to say it has made sense to basically have a growth tilt on your global equity portfolio, but being mindful of relative valuation. So in other words, the GARP investing strategy is to look within growth pool and select from it those at a reasonable price. The other observation, the second observation I wanted to tee up looking forward into 2026 and 2027 is that market consensus expectations of earnings growth. It looks like things are going to broaden out to better earnings per share growth profiles found in Europe and Asia. And so in other words, having basically a mindfulness for global equities and being able to stock select within that larger selection pool and picking out the companies that exhibit most strongly growth at a reasonable price attributes. And the second or third and last final observation and teeing up the proposition for GARP investing is that if you look at international equities, specifically US ones, valuations are quite high. And so again, GARP is mindful valuation. If you looked at the CAPE ratio as it stands today in the US on the S&P 500, the magnitude is well above the 50-year average and well above the longer term data, which dates back all the way to the 1900s. And okay, so this is actually a relevant slide to the right. And it basically shows that the higher the PE, so the price at which you purchase the stock, tends to be negatively correlated with 5-year future returns. So in other words, you purchase the stock at a high price, forward returns are perhaps lower. So that basically tees up for the next part, the next phase. So I touched on the fact that GARP is inclusive of growth factor, inclusive of value factor, but as a matter of fact, it also encompasses quality. So what we're doing is we're going to the growth stocks, we're selecting among them those that have comparatively more favorable PE ratios, and also those that have quality factors in terms of the least financial leverage, as well as the highest return on equity in terms of capital efficiency. So we started running this strategy on the basis of an S&P index, which Jason touched on, in September 2024. And since we launched it, it's outperformed the single factors across the board: momentum, company size factor, value factor, quality factor. In over a 7-year period, it's done the same, so a longer time horizon. Interestingly enough, also, it's achieved a lower level of volatility against the single factor growth and the single factor company size. Jason did a really wonderful job in laying out how we basically stock select to curate a global equity portfolio that's postured toward growth at a reasonable price. And so again, along those 3 factors for growth, we're looking at companies that exhibit the strongest 3-year earnings growth, sales growth, quality, highest ROE, lowest financial leverage, and then looking at the style factor. And from that, we filter down to a 250 stock portfolio. And to the right, I wanted to show the top 10 holdings of the GARP portfolio as it currently stands. And because it's a systematic, index-based, rules-based approach, you can very transparently see why a stock, as at the rebalance date, has been included in the portfolio. So looking at each of those metrics along each of those style factors that I pointed out. So now we really get to the question, well, how has a GARP portfolio performed against the total market world portfolio? So think MSCI World. So if we're trying to stock select for those profiles of high EPS growth, high sales growth, not too much financial leverage, high return on equity, with a mindfulness to the PE ratios, trying to take the least highest PE among the growth stocks, how have we done against the world portfolio? So along each of those considerations, each of those factors, it's proven to be better. And we've also de-amplified the PE risk. So the growth portfolio, growth at a reasonable price, is about 20 times a multiple, whereas the MSCI World is about 24 times. In over 3-year, 5-year, 10-year performance periods, there's been an excess return that GARP's achieved vis-a-vis the MSCI World of roughly 3%, which Jason touched on. Drawdown behavior. It's very comparable to the world equity portfolio. Sometimes, however, it will draw down a bit more sharply, but it exhibits stronger bounce back power in the context of where and when a recovery occurs, so upside capture. So now these, keep in mind, are a bit different, the slides, but that's okay. So I actually wanted to close by showing how the GARP portfolio rebalances, because that's the time at which you can see its selection choices. So you can see how it does the stock selection in terms of additions, deletions, and allocation effects in terms of geographies into which it tilts and so on and so forth. So the GARP portfolio rebalances twice a year. So that's the occasion on which we revisit the universe and we stock select again. And on December 2024, we actually took Tesla out of the portfolio. And if you see, you can see that the blue line, Tesla's PE had rapidly escalated. So that was the reason for the deletion. And subsequent to the deletion, Tesla's share price fell. So that seemed to have been a good stock selection choice. That's just a mere sample. There's other things that we could talk about. Uber Technologies, was entered into the portfolio at that time, as well as a Spanish financial holding company, BBVA, each of which, after that December rebalance, did very well. Now, very lastly, to wrap up, I wanted to point out on its most recent rebalance this year in June, the portfolio tilted into Japanese equities because there was earnings momentum there and relative value to be found there. And after the June rebalance, you can see that Japanese equities outperformed the MSCI World as well as the S&P 500. So that's that. Thank you so much.
Thank you, Chad. Very thorough overview. And as you can figure out, GARP is very much front of mind at S&P and Global X, very timely given our recent launches. I wanted to start the conversation by maybe going a little bit more broad. The topic is on global factor strategies. So maybe I'll start with you, Jason. Can you maybe summarize some of the key trends that you're seeing with global factor strategies, especially, with the growth and development that we're seeing with index-based strategies?
Yeah, of course. And I'll keep it high level. So I think three major trends. One is income thesis resonates across the world. Whether you look at the US market here in APAC, Australia, income yield generation, this is really super resonating from the fixed income space to the dividend in the equity side to the covered calls. People are building diversified different approaches in terms of income generation. The second theme, if you look at on the single factor side, quality and momentum has done really, really well over the past 2-3 years. We have S&P 500 quality and S&P 500 momentum in terms of ETF assets tracking those is just booming over the past 3 years. And it's in the very good performance cycles. And the factors or the fact indices that delivered, what the objective hope to achieve. And lastly, we see some of the new kind of, we call factor 2.0 factors that are not in your traditional definition, like free cash flow. We also have aristocrats franchise in the dividend side. So some of the innovative products coming out to the market.
Thank you. And Chad, would you like to add your perspective to that?
So at Global X, we canvass a wide variety of strategies. So one of which is the growth at a reasonable price approach applied to international equities as well as domestic equities. We're always in search of interesting investment areas, either for tilting purposes or more core buy and hold positioning. And keep in mind, the great thing about being multi-asset is we can enter into any area. So I flagged the fact that, for example, Global X were very heavy in liquid diversifiers in the form of precious metals, so that non-correlation tool. So we can go and look at commodity strategies. We can look at income strategies over fixed income. Fixed income is interesting because from a factor point of view, there's certainly been conversations about whether or not there's factors existent within the fixed income space and whether or not you can equally seek out factor returns in that area versus the equity area. And I would be interested, in fact, to hear S&P's thinking on factor investing with respect to fixed income, which would be interesting.
Yes. I don't know, Jason would like to comment on that. We will actually have our PM for fixed income here in November.
But in terms, I'll quickly address like some of the common factors. We do have a fixed income factor indices and franchise in terms of in the strategy flavor. But some of the examples like you can look at yield, you can look at duration, like just similar to the equity approach. You can use kind of the systematic rule-based way in terms of how you construct your fixed income bond portfolios or bond index, and then tilting a little bit towards when the market is like a higher risk or higher credits or longer durations. That type of approach definitely also exists in the fixed income side. Yeah.
I know at Global X, you have quite a wide range of ETFs now. You're 47 for launch. I can only remember that because it was actually at the launch 2 weeks ago, which happened to coincide with being the 400th ETF launch on the AXX. So that is my little bit of history that I'm going to remember being there. Chad, I know while you and your colleagues speak to financial intermediaries, which are represented here, you may deal more with the institutional clients, but your colleagues are, speak to asset managers, financial advisors, wealth, family offices. Where is the main interest in factors? What are they asking for? What are you seeing in your conversations there?
It's interesting. Usually some factor expression, just zeroing in on GARP, is expressed typically through active managers. So right now we're going through a process of basically changing mindset that you can achieve consistent, systematic growth at a reasonable price exposure on a domestic equity basis or international equity basis through a systematized index approach. So really that's the feedback, and also is, you know, how do I time the factor? And the great thing about having something of a composite factor approach is that you have a little bit of everything. Otherwise, you're thinking about, well, do I rotate into this factor? Maybe it's value at this point in time, but then what's the point in time that I go back to another factor, this, that, the other? So those are the type of conversations we're having. Basically, GARP through index versus active, and then just talking about the other item that I mentioned.
Moving on to our next line of questioning, implementation. I know for many of us here, we see the end product. We really don't think about, you know, what happens getting the product to that stage. Jason, can you maybe comment on some of the challenges to implementation, especially when you're trying to work out the methodology? And I know with GARP, well, when, you know, dealing with single factors can be challenging enough. And when you're trying to do multiple factors, that adds further complexity.
Well, so first of all, I think GARP as a bit of multi-factor because you have the growth layer, you have the earnings to price valuation, you have the quality considerations, and it's a two-step kind of sorting approach. So I do see that it's much more complex than a traditional, just a value single factor or quality single factor approach. But I think from my perspective on index construction, I always say that the devils are in the details. Even one line of the difference in index methodology could lead to a very different outcome in the index historical backtest performance. And just take we have the S&P World ex Australia GARP, we also have the S&P ASX 200 GARP. Those two comes with slightly difference. Just for example, the S&P ASX 200 GARP, it take out the leverage ratio from the quality matrix. Why? Because we look at the empirical studies and we found that financial leverage as a matrix itself is just not super robust in the Australia. And Australia market, you have very concentrated in terms of the 5 big financial companies. Does it make too much sense in terms of using the leverage compared to financials versus non-financials across the board? So that puts a question to the methodology, and we actually modified slightly to better fit the local market dynamic. Yeah, so a bit more on that. So the ASX 200 GARP is essentially you start with the S&P ASX 200, you select top 150 names on the growth score. So the growth is the exact same definition. Step 2 on the 150 growth, you select the top 50 names by quality value. So you really within the growth amplify the impact from the quality and the valuation. And here on the quality, we're just using ROE, return on equities, which is a very robust matrix across the world, and then on the earnings to price. So all of the matrix we use is the same. The change here is 1 on the screening, on the selection, target stocks. 2 is we get rid of the financial leverage. Yeah, and then the weighting scheme is, this FMC times the quality value. So again, we put more emphasis on the quality value side rather than the growth. Because the growth itself, the 3-year is kind of cyclical, and Australia tend to be more cyclical than some of the other markets, right, as you see. So that's why we modify some of those. And in terms of the results, we have a paper on that, and feel free to check on our website, like in terms of what it looks like historically. Yeah.
Before I hand over to Chad, I think there's a question in the back corner.
Yeah, look, it's actually a question mainly for Chad. With Global X, Chad, you were talking about you were dropping this stock and picking up that stock. Now, are you just using an index, or are you working the index? Is it your selection, or are you just following an index?
It's great to see you. Actually, we haven't talked in a while. It's index approach, so it's S&P's index, as a matter of fact, that we use as an index partner. And basically, the index serves as a stock selection strategy. Our portfolio managers, on the occasion of the rebalance and reconstitution date, will look at the basically portfolio composition file of the index. And on the basis of that, we'll make additions into the portfolio and deletions out of the portfolio, if that answers your question.
And if I can add on top of that, so from the index provider, we emphasize a lot on index methodology. So our index construction strictly follow the index methodology step by step. So you have the data input, you look at index methodology as your menu, and then you're basically, constructing the index. So the outcome, if you look at from, the backward looking, like some of the great examples Chad talks about, yes, like we get some of those numbers and some of the names right. But remember, index is a very well diversified approach, right? It's 250 names. If you look at it, this is not like single stock selection. We are not, picking stocks to your point. We are just using the data input and following the systematic construction. Are we getting every single name right? Maybe not the case. Are we getting every single name wrong? Maybe not the case neither, right? But the key here is have a well diversified index or exposure to some of the factors that you think can generate long-term risk premium excess returns in a rule-based approach, in a transparent approach. So that, I think want to clarify, index provider is not a stock picker. Yeah, so we do, look at the methodologies, and the methodology is probably available on our website. So feel free to check on that. Yeah.
Unfortunately, I think our time is up already. That went very quickly. Thank you, Chad and Jason.
Thank you so much, Julie.
As passive investing and the derivatives of index-based investing have become more and more significant, issues such as the one we covered just now in the sort of relative importance of this or that factor is becoming increasingly part of the thinking process for advisors and portfolio constructors. And it's fascinating to see the depth of understanding that's progressively emerging in this market. So now, look, we're going to take a break for 20 minutes. There's another cup of coffee outside for you, or a fruit juice, or a comfort stop. The cloakrooms are just at the sort of back of the corridor there. I'll ring the bell at 10:15, and on return, as I promised, a sample of the sponsor's fine product from the World Gold Council.
Hi, Jenny. Good morning.
Good morning.
Morning. I can hear a bit of feedback on my side.
Sorry, what was that?
I could hear a little bit of feedback on my side
No
when I'm
worries.
talking.
It's my phone. I've just.
Oh, okay.
Okay. I might, is it, okay, I might get you to please share your screen and then.
Yeah, sure.
So that should be fine.
Okay, sure. Let me try that again.
gold market has been evolving for decades, and the World Gold Council has actually been at the forefront of that development.
There are always new ways to think about gold, and it's our responsibility to champion those.
By being involved in every aspect of the value chain, we are able to help drive industry progress from mine to market. Gold has a critical role to play in society.
We provide data, research, and tools to investors that help them understand gold.
There is no comparable resource out there.
We have been at the forefront of responsible gold mining.
We developed and issued the Responsible Gold Mining Principles, by which the entire gold industry should act.
Gold mines add value to communities. There's infrastructure created, from roads to schools, hospitals.
Supporting the vitality of these local communities.
The key aims of the Retail Gold Investment Principles are to bring trust and understanding to the market. We are working with dealers across the world so that they demonstrate that trust to the investor. We have developed mandatory hallmarking in India.
Hallmarking is a stamp of trust and transparency in the gold that people buy.
We have been instrumental in opening up new markets around the world.
We've worked with governments and regulators in the industry to support the development of transparent pricing information, where the gold comes from, and who is involved in that gold ecosystem.
It will help provide confidence for the investors to trade gold.
Gold 247 is our vision for transforming the gold market to meet the needs of today's consumers and investors.
We are going to see a universe where every gold bar is logged in a digital database.
Creating a digital twin of every single bar in a distributed ledger.
The benefit is to have one source and one form of gold tracked worldwide.
We are trying to make gold as usable and as friendly and as transparent to trade as any other asset class. The process of digitalization will allow that.
We lead the way in advancing the gold industry.
We are focused on only one thing. We are focused on gold. And so as a consequence, we are experts at it.
Okay, that was good. Okay.
You want to have a go at sharing your slide?
Yep. So this morning Matthew sent a slide deck with a cover for the event. So I'm going to share that one. This one. Yep.
Yeah, that's the right piece.
Okay, great. Yeah, I think I think we're good to go. So should I keep this one on?
Yes, that would be great.
Okay, great. Okay, sure. Thank you. See you in a bit.
Bye.
Bye.
Look, let's kick off now once again with our next session. As I promised, a sample of the sponsor's fine product, and as those of you who've been disappointed before will know, often the sample is not life size. So it's now my pleasure to invite Francie Taylor, who's Executive Director for Managed Accounts, to the stage to take us through what I know is a very interesting session focused on gold and its place in the portfolio. Francie, over to you.
It's not often you can actually wear your asset class, but I am. So welcome to this session. I am delighted to host this session, and I have with me Marissa from the World Gold Council, Jason from Resonant, and Clive from State Street. And without them, this presentation wouldn't have come together. I'm actually just going to introduce with a bit of the emotive part to gold. It is in our Australian and world psyche. It is one of our oldest asset classes. In fact, it was supposedly discovered 3000 BC. If we wind a bit forward, it was also in our childhoods, in our fairy tales, with Jason. It was in a lovely story called Rumpelstiltskin. I don't know if you remember that, and drives back memories of your mother telling you that story. Our first gold rush was 1851 in New South Wales, actually in a town called Orange, and it was the first discovery of nuggets. Why that was important from Australia, it turned Australia from what was a colony of convicts. We suddenly had money and we turned more into cities. We didn't become a national country by then. We were just able to get more money to grow cities. On the really human pursuit side, we run for it, we cycle for it, we swim for it, we ski for it. We have elite athletes that go out of their way to train to get that gold medal for Australia. Some of their coaches will stand, and one of ours used to yell at the end of our pool, saying, "It's goddamn on the chemical elements chart, and it's AU. So of course you're going to bloody get gold for Australia." So needless to say, I didn't, but I'm wearing gold. But we have another gold rush. And if you look at Martin Place, it's astounding. There are queues going back. I actually thought it was the Apple store had moved and people were queuing for the mobile phone. But that had happened a month ago when the new phone came out. This gold rush has been going for the last month. So we're actually going to go through that driver of an incredible price that's gone over the 4,000. And we're also going to look at it in other pursuits of why you'd use it in a portfolio, how you use it for diversification, for returns, for liquidity. What is the percentage that potentially you should use as the diversifier? And I have got the gurus with me today to do that. So that's the emotive side of gold. And now Marissa's going to give us a bit of background on the real story of gold. Over to you, Marissa. She's on screen.
Thank you very much, and good morning, everyone. Good morning, Francine. That was a really beautiful introduction to gold as well, and you're looking very lovely there. I can see you on the screen.
Very good.
Thank you. Yeah, so I'll first start off with the introduction video about what the World Gold Council is. I think that would give us a bit of idea as to who we are. Okay.
The gold market has been evolving for decades, and the World Gold Council has actually been at the forefront of that development.
There are always new ways to think about gold, and it's our responsibility to champion those.
By being involved in every aspect of the value chain, we are able to help drive industry progress from mine to market. Gold has a critical role to play in society.
We provide data, research, and tools to investors that help them understand gold.
There is no comparable resource out there.
We have been at the forefront of responsible gold mining.
We developed and issued the Responsible Gold Mining Principles, by which the entire gold industry should act.
Gold mines add value to communities. There's infrastructure created from roads to schools, hospitals.
Supporting the vitality of these local communities.
The key aims of the Retail Gold Investment Principles are to bring trust and understanding to the market. We are working with dealers across the world so that they demonstrate that trust to the investor.
We have developed mandatory hallmarking in India.
Hallmarking is a stamp of trust and transparency in the gold that people buy.
We have been instrumental in opening up new markets around the world.
We've worked with governments and regulators in the industry to support the development of transparent pricing information, where the gold comes from, and who is involved in that gold ecosystem.
It will help provide confidence for the investors to trade gold.
Gold 247 is our vision for transforming the gold market to meet the needs of today's consumers and investors.
We are going to see a universe where every gold bar is logged in a digital database.
Creating a digital twin of every single bar in a distributed ledger.
The benefit is to have one source and one form of gold tracked worldwide.
We are trying to make gold as usable and as friendly and as transparent to trade as any other asset class. The process of digitalization will allow that.
We lead the way in advancing the gold industry.
We are focused on only one thing. We are focused on gold. And so as a consequence, we are experts at it.
All right, so that is the introduction video. Sorry about that. Okay, so that's the introduction video. Right now I'm going to go on the slideshow. Just give me a moment. Okay, perfect. So I'm from the World Gold Council. My name is Marissa. So today I'll be sharing the introduction about the gold market. So as you've probably heard earlier on, so we are a non-profit membership organization for the gold industry, and our key vision and mission is really quite simple. We want to stimulate and sustain demand for gold, and all in all, we want to provide the improving the understanding, access, and trust as well in the gold market. So the World Gold Council is filled with people who work with policymakers, for example, financial regulators, institutional investors, as well as to some extent retailers in the jewelry sector, for example, in China as well as India. We really want to cover the whole entire gold ecosystem, and we have the people who work with these different industry players. So I'll first start off with sharing about how much gold is there in the world, if you've ever wondered. So it really sits in this cube. So this cube is really the balance sheet of gold worldwide. If you look at all the gold that's above ground that's ever mined, and then you melt them all and put them in a mold like this, it fits into a cube. It's about 20 plus trillion right now, because the prices have gone up since the time that we did this. But in terms of percentage for jewelry, technology, as well as retail bars and coins, this means that these are in the hands of consumers. It's around 70+%, and investors have about 8% of their piece of the pie. And we also have a interesting driver of the market, which is central banks. So central banks around 17-20% right now. And looking at gold, it is really a global market. You have gold demand in all corners of the world, but more importantly, it's really an Asia Pacific story. It's becoming an Asia Pacific story, and it's quickly moving from the West to where we are. Around 70% of gold demand, it really sits within emerging markets. And out of that, half of it is really sitting in Greater China as well as the Indian subcontinent. So these two locations really drive the demand for gold, especially on the consumer part, when we're looking at retail bars and coins, as well as jewelry. We also have Southeast Asia, others at 11%, and Middle East at around 10%. But some of this Middle Eastern demand actually really flows into India as well. So when we look at supply is also quite global. We have gold in all corners of the world, except for Antarctica, but probably if you dig very deep, we don't know. We basically don't know if there's gold in Antarctica, but there are gold reserves in all parts of the world. Mostly it's coming from Africa, about 26% of that. We also have Oceania, which is where we are, around 10%, and then in the Americas we also have around 30% as well. So some interesting, you probably know this, but when we talk to a lot of investors, and then they think about, a supply shock to the market, they think that it's quite fluid. It's a bit like oil, you can drill and put it in a barrel and send it out to the world, and then the prices can get influenced in that way. Just to put in perspective, 1 ton of ore that you crush, you only probably be able to get about 0.5 gram to 3 grams of gold. This is talking about open pit mines. When we're talking about underground mines, that same 1 ton of ore, you probably can get a higher yield, around 2.5 grams to 5 grams of gold. But the point to share this is that for the gold market, we do see supply being quite tight, but then demand is elevated based on, the factors that all of us are familiar with throughout this year. And for gold, it is an interesting asset class because it has a dual nature. The first is that it is both a consumer good as well as an investment asset. That being said, during periods of, expansion, when people are a bit more optimistic, they have high disposable incomes, we have around 40% gold demand really sitting in with the jewelry and technology. And again, for jewelry, it's really driven by demand from India as well as China. These are really huge markets for jewelry itself. When it comes to times like this, where we're a bit more uncertain about the future, we don't really know what's going to happen, a few months down the line. We have investment demand, which is accounting for another 40%, which is what we see as a current demand driver for gold, which I'll talk to in a bit. When it comes to central bank, they're a bit more cycle agnostic. They do buy gold, or they accumulate gold reserves based on a multi-year buying program. They also have a target. For example, if you've read recently, Bank of Poland said that, we've reached around 20% of our target. So we're happy with that. But the week after that, or 2 weeks after that, the governor came back out to the world and said that, look, I want to increase that from 22% to 30% of my reserves. So central banks are diverged away from maybe what's happening in the market in general, but they have a bit more of a specific agenda as to how they want to get their gold reserves and gold accumulation programs. So as you know, gold maintains its strong year-to-date performance. It's actually reached around 4,000 plus. So this was when I made that couple of weeks ago, and it's reached around 40 plus all-time highs already. And we are seeing that also comparing gold, not just in Australia, but also in many parts of the world where, as an asset class, it has lead a lot of the traditional major asset classes in local terms. So it's really the asset class that's been shining for 2025 on the back of a few different factors that you're probably quite familiar with. And another thing about gold is that when markets, or it's the future or further expectation of probably a pullback in the equity markets, for example. So this is what people have been talking about, especially in the US. Gold is as an asset class is that diversifier. It becomes more negatively correlated with stocks in extreme market sell-offs compared to correlation between bonds and equities, for example. And just trying to go into the next part here, which is what is driving gold demand. So there are three key things that are driving gold demand in 2025 so far. So 2025 has been marked by a series of exogenous shocks. You can call it that way, or perhaps some people expect that, since Trump got elected. But the main thing is that there are a few drivers for gold that is separate from maybe what's driving the equities and bonds, right? The first is safe haven flows. So that's what we are seeing in gold-backed exchange-traded funds. It has had a strong start to the year with sharp inflows from North America as well as China. So just to put in perspective, in 2024, there were outflows for global gold-backed ETFs, but in 2025, it really started with a bang, and it has continued accumulating ever since. So we have the recent peak of 3,100 plus tons of gold-backed ETFs, and we are quite near that peak right now at this current point. The second part is also a story that you've probably been hearing about gold for this whole 2 years. It's probably the central bank's demand. For the first half, it has remained healthy and it's driven by emerging markets, mostly Poland, Turkey, China, India. We have some countries in Central Europe as well as Central Asia. They are the ones that have been accumulating. Do they still have room to run? You can look at it from the perspective of how much percentage of gold is there in their reserves. So a lot of these emerging markets have single digit percentage. So for example, China, reported central bank buying has been around 7% so far. So versus, the US, which is around 75% of their reserves is actually gold. So you can probably imagine the rest of these central banks have US dollar denominated assets as well as gold in their portfolio, whereas in the US it's opposite. They've got more of their reserves in gold versus other asset classes. And again, back to the story of India as well as China. So there's gold bars and coins. This demand has been really driven by Asia Pacific so far. It's been the strongest first half that we've seen since 2013. Demand is largely driven by our region here. And just to put in perspective, global demand, right? Percentage of global demand from Asia Pacific on gold bars and coins is around 60+%. So this has really been the momentum from investors, retail investors, as well as we've got both retail and institutional investors going into the exchange traded funds. So that's me. So hopefully that was useful, and I'll pass back the time to Francie.
Thanks, Mary. So that was I have to turn this on, but I'll speak loudly. Marissa, thank you. That was great insights into the facts of gold versus the emotive of gold. And so now we're going to look more at the academics of gold in terms of Clive has written a thesis on gold, and in particular, how you use that in a portfolio and what percentage do you allocate to, and what are the things are we running to it for a safe haven, as Marissa commented to, or what does it play in that portfolio construction role?
Yeah, thanks. So the paper I wrote, it's very kind of you to call it a thesis. It's just more of a research paper on the potential uses of gold in a portfolio. So most of my career in investments has really been as an asset allocator. And most asset allocators, we're really comfortable with things that we can, do forward estimates on so that we can plug it into our models and put it into a strategic asset allocation. Now, gold, despite being the oldest asset class that we have, has been mentioned already, it's actually quite difficult for asset allocators to model forward-looking returns. So traditionally, it's sort of been cast aside when you're considering your strategic asset allocation. But we wanted to sort of rethink that case and sort of challenge the notion that it's been used mostly as a tactical asset allocation change to most portfolios, particularly in the wake of disruptive events, whether it's market events or geopolitical events, or currently when the prices really run quite strongly and interest from the general public and general investors has increased. So we wanted to challenge that notion that you can actually hold gold through the cycle, through multiple cycles, and how it works in a portfolio with multiple asset classes, your bonds, your equities, and your alternatives. We think it stacks up quite well when you look at it from that perspective. In fact, probably stacks up too well, because in theory, when you do the modeling, 10, 20% allocations to gold actually work quite well. But in terms of a practical allocation to your portfolio, you probably want to stick to somewhere around the 5% mark. So 2 to 5% is where we think is a sweet spot for most multi-asset portfolios, where you get the benefits of holding gold in your portfolio, and it gives you those diversification benefits. You benefit from the price appreciation, but you also have diverse sources of returns in your portfolio as well. So we think that's where you should be pitching.
Thanks, Clive. And the paper also addresses how you access gold. Yeah. Do you want to talk through the ways in which people can access gold?
Yeah, I mean, there's been a tremendous shift in terms of how you can access gold. So Marissa's mentioned, a lot of traditional demand's been around gold bars and coins, and you see the Malines and Martin place. People still think of gold in that way, where you want to have it physically in your hands. But we've had a tremendous shift in financial markets over the last few years, where there's been better ways to access gold for investors, and particularly ETFs and managed funds that offer you all the benefits of gold ownership without sort of some of the costs of physical ownership and the difficulties of storing it and so on. Plus, you get that financial market transparency and liquidity available to you whenever you need it. So whether you're using it as a strategic asset class or a tactical asset class, we feel some of those financial market solutions are a better solution for investors to be accessing the market. And we've seen tremendous growth in the ETF space in particular over the last few years.
Thanks, Clive. Jason, how is Resonant using it? And are you looking more at shares, ETFs, combination? Can you sort of talk us through that?
Sure. It's a combination. Running managed accounts. It's obviously limited to what is on platform. So physicals, not necessarily the easiest thing to do on a managed account, but yeah, we look at it through a number of different lenses. So on a sort of more of a total portfolio approach, so we're going to be looking at things like ETFs, or we're looking at actual funds, or we look at actual gold producers as well, so gold miners. So Newmont obviously being one of the biggest that we would see, and I guess that then is giving you a little bit of operational leverage into the gold price, and you just want to understand how they manage their hedging and forward sales as well to make sure that you're getting exposure to the right drivers in that sense.
And that particular stock not only delivers the capital, but they also tend to pay dividends. Is that correct?
Yeah. So one of the things we've always struggled a little bit with gold when it comes from particularly if you'd like talking more defensive portfolios where people traditionally want some yield out of it. When you've got a gold ETF in there, just pure gold ETF, the question is always like, well, it's not paying any yield, so it's not adding to my to my overall distribution. So a stock in the case of Newmont is a good one there, because you're actually getting a dividend out of it as well. So and yeah, you're getting sort of say best of both worlds, but there is, obviously a different downside scenario to that, but that does help.
Can I sort of throw it out to all of the panel in the sense that we talk about it as being negatively correlated, yet we're seeing both equities and gold steam unitedly up. So can we talk about the drivers in both those markets? Would be good. Do you want to start, Jason?
Sure. I've got a slide that I'll just pop up with some of the tailwinds that we're seeing at the moment, and I can't really even read my own slide there, but I'll just try and remember. Yeah, that's all right. But broadly, if you look at it really from a top level macro point of view, we think ultimately, it's a multi-pronged story. You've got one element of this is really US dollar story. So you've obviously got most of what we see in the 4,100 today in terms of the price, is in US dollars. So we've been seeing a decline in US dollar value, and that's likely giving some lift to gold as a sort of a baseline. So, but then more broadly, you've really got, if you go to sort of the next level, central banks, governments worldwide, they're not backing off on their spending. They're continuing to basically look to inflate their way out of debt and to a degree debase their currencies. And as a result, I mean, if you look at the US right now, and I know Trump was sort of saying he was going to address it, but current account deficit is still sitting at, I think, sort of roughly about $1 trillion a year. So that's a net $1 trillion leaving the US in terms of just economic outflows, created but leaving. Now, if you go back 20, 30 years ago, a lot of that would have really been kept in US dollars and stored by central banks as reserve currency. That's not happening as much anymore because we've got a lot of obviously big shifts in the way that the world's being structured at the moment. And as a result, a lot of those central banks, this is back to what Marissa was saying about central bank activity, particularly in Southeast Asia, they're not holding those US dollars, they're looking for something else. So that something else at the moment, in some cases, is gold, and they don't necessarily have like the sensitivity to buying it from a price point of view that a lot of other retail groups would, or traders. So they're just buying it on a program because they've been mandated to by the government or by by their parliament. So that creates like really one-way demand in that respect.
Yes. Also, in terms of what Ms. Rose spoke about, in terms of what the World Council is trying to do is digitalise it and therefore give it an even keel for price valuations and therefore making it more tradable, easily tradable, I suppose. Commenting on that in terms of what you're seeing in terms of funds management, how they're accessing, where we're going in terms of that. And Marissa, please, I can't see you to chime in there. Because I think in terms of platform.
Sure.
Oh, sorry, Marissa.
Yeah, sure. Yeah. So, so the World Council recently had a white paper on the framework on digitalization of gold. So the idea is that we want to, so firstly, people can have access to gold through the allocated gold as well as the unallocated gold. There's also a third way where they get a piece of an unallocated gold gold bar using X point Y ounces of allocated gold bar. So basically, you just want to make sure that you're able to fractionalize a gold bar and make sure that someone can have a claim to it, and if that is traded, it will be assigned to the next fractional bar. So at the end of the day, you have some gold bar that you're able to track. So there are some players in the market. I'm talking about Singapore that have been doing this or have been trying to market out fractionalization of gold, and the idea is also quite the same. What the World Gold Council is trying to do is that we're trying to build an ecosystem for this, and the main aim is that to make sure that the gold access it can be fractionalized 1 out of 1,000 or 1 out of more than that, so that people can have access to that ecosystem as well.
I think it's going to be tough to do that. And I just sort of go to let's go to a scenario where you've got a vault of gold that you've got an NFT, fractional NFT over the top of that, so non-fungible token. So like digital rights over that. There's a military coup in that country, and then you turn up with your digital token and say, "Oh, that's mine," and they're like, "On your bike, mate." Like I don't know how that works. Like if you're holding it under the worst case scenario, you can't do any other thing than hold it physically, to me. So if you've got stable government, you've got a surety of that link between the token and the physical asset, that's fine. But it depends what you're holding gold for. So I'd say that if you're holding it for end of days, you really probably want to have your coins. Or your silver, actually. We were talking about this before. So silver's probably better in an Armageddon scenario because it's a smaller value. They'll shoot you for your gold coin.
Yeah. And so in that sense, we've talked about ETFs, we've talked about funds, we've talked about fractionalization and perhaps that pursuit of making it, much more easily tradable and accessible than the physicality of the gold. You also talked about ETPs and how that works with the Perth Mint. Talk through that.
Yeah, so that I quite like that Perth Mint. I don't know if anybody's familiar with it, but so ETP is exchange traded product, and it basically gives you rights over physical gold at the Perth Mint. So there's a few steps involved. You can buy it on the exchange, on the ASX, and then you can actually elect to convert it into a Perth gold allocation, and then you can actually turn up there and say, I physically want it. So that, I think at least that's within a contained ecosystem. And I think that's actually a pretty cool sort of approach to do it. But there's cost in converting, so you're paying a fee to do that at a number of different steps. And then you've still got to get KYC before you turn up. You just can't turn up with a share certificate. So I've never done it myself, but I read about it. It seemed pretty cool.
It is, in a sense, we're using it for a defensive means, but actually it's actually tagged as a growth asset, is it not? And so that sometimes causes issue in how you use it. Do you want to talk through, either of you to talk through that?
Yeah, sure. I think I alluded to it earlier in terms of, the asset allocator's dilemma is where do you put it into, do you put it as a defensive asset, or do you put it as a growth asset, or do you put it as an income asset? And, we know the challenges of doing any one of those things. But we think instead of sort of focusing on those top level categorizations, I think you put it into a portfolio. What it actually gives you in a portfolio is better defensive characteristics than some of the alternatives that people are turning to right now. So as a portfolio holding, it improves your risk return profile of that portfolio. Never mind what the return profile is of gold at the particular moment. I think through time, over long periods of time, it does help the portfolio volatility, particularly in terms of market stress. So I think it's very difficult to predict those times when those times happen, but I think you will see the performance there. So I think as a whole, it probably would qualify as a defensive allocation in a portfolio.
So what are they selling to get the allocation to gold?
Well, we've seen a variety of things, but it tends to be more equity holdings, actually, as a hedge to your equity holdings. But we think it actually acts as a hedge to a 60-40 or multi-asset portfolio. So you can sell out of your bonds, out of your equity. So in the paper that we did an exercise where we were taking allocations out of different asset classes to see the impact that it has on portfolios. And it was a pretty similar impact, whether you took it out of bonds or equities in terms of the impact on portfolio risk. But the example we presented takes it equally out of equities and bonds and allocates it to gold, and you do get that benefit coming through.
Brilliant.
Yeah, I mean, it's a pretty tricky one, right? I mean, because platforms and most people are going to categorize as an alt, and then an alt is generally growth. But, the way that we've sort of used it interchangeably at times for that more of a alt defensive play, I guess, or something that has a lower or negative correlation, There's an ETF called T-bill, which is like US Treasuries, and some of our clients prefer that because it's got the yield, so you get paid yield, and it's sort of like a very short-term bond. So if there was, effectively emergency rate cut by the Fed, then that's going to kick under that scenario, and gold will probably do a similar thing, but obviously gold does pay dividends. So we sort of sometime when we've done the modelling on them, outside of those real big extended market sell-offs, they sort of tend to work reasonably well in the short term, but the longer term gold's obviously done very well lately. And even if you look, so 2 examples just in the last sort of period of time, even just recently, like was it 2 days ago when the market sold off when Trump said something, you had gold was actually really the only thing I saw on the screens that was really up. So even despite all the strength we've had over the last few, year or two. But then on the flip side of that, if you look at COVID, gold was actually down for a couple of days in the worst of it because people were just liquidating everything. They're just trying to raise cash. So it may not always behave exactly how you think in that short-term correlation stage, but longer term, it obviously through debasement of currency and as things are inflating, gold obviously holds its value generally. We've seen that as pretty observable now.
Yeah. Yeah, I'd add that humans don't normally behave as we expect. So between Marissa, Jason and Clive, are we going to put a golden crystal ball and indicate where we might see this run end and where we think a range is in dollar value? Not that I'm putting you on the spot, but I am.
So I'll start with a bit of a confession. So we've had 3 bull cases for gold for 2025 in the last 12 months, and gold's blown through all of those bull cases. So I think my record in terms of predicting where this price will end is not great. But I will say, given gold's a really topical issue at the moment, and a lot of people sitting in this room are probably thinking, I don't have an allocation to gold. It's already at 4.1. I think it's too late. I don't think so. I think, as we said throughout the session, gold has more roles to play in a portfolio than just price appreciation. So I think it's not necessarily too late just because the price is at all-time highs or whatever it is. So that's my take. I'm gonna.
Thank you for that admission, Clive, too. Jason?
So I did this panel last week in Melbourne. I'll say the same thing. At least a 51% chance it'll be higher.
51%.
Which means that technically I'm bullish on it.
Yeah,
So,
technically.
But compliance doesn't like me to give numbers out. So, but yeah, look, I think, as per the slide, there's a lot of tailwinds. I think the only thing that could potentially be a headwind to it is allocation into other alternative, commodities or, copper. People probably haven't been picking up. I don't know if anybody's watching copper price lately, but that's been absolutely screaming. Silver's over $50, overnight, I think. So there are other things you can go into to get the same sort of protection if your view is on the macro side of things around why it's doing what it's doing. If you just want to have gold because you want gold, and if you'd like one to go and join the queues down Martin Place just so you can have then that's sort of a different short term. So, but yeah, I think longer term, it's got a lot going for it.
And Marissa, I know that the World Gold Council isn't supposed to comment on this, so any last comments from you?
Yeah, sure. So I think what we do at the World Gold Council is really research, historical data so that we have something to look back on. And our recently released blog, really at Gold at 4,000, dives into that, the different historical bull runs and how much gold is in the accumulation phase. So I think not trying to put numbers or comment, but I think the blog also details where we are in the cycle. So I think it's worth a shot to have a look at that as well. And again, echoing all the other panelists, I feel that there's a lot more opportunities for gold going forward in 2026 based on the different macro drivers that we're seeing so far.
Brilliant, thank you. And I think Toby now would like to open up the floor to questions from.
Stephen, do you want to?
Gold, like any asset, capital goes up with supply and demand. Obviously, big demand now because there's lots of turmoil and all those reasons you've given. But just looking at the graph going back 100 years here, and there are decades, like from 1980 right through to the 2000s, where it's done zero. So as an asset allocator, I'm going, gosh, you know, here we are. It's really gone through the roof now. But when it was like $200-400 an ounce, then it creeped up to 1,000 an ounce, 2010 from 2000. Can you see sometime in the future, Democrats are in the US, Ukraine's done and dusted, Russia's gone, things are happy and normal on the planet. Have you done any forecasting of what, you know, would you still hold your 2 to 5% in gold as an asset allocator?
Yeah, it's a great question, and I should have mentioned it earlier. So the exercise we did covered about 30 years of history, and in that 30-year period, you did have sort of I'd say 15 years of lost, a decade and a half lost in terms of no price appreciation from gold. So sort of from about 1995 to about 2004, and about 2011 to about 2018, gold did like nothing, 1% a year in terms of cumulative growth. Even in those periods, we isolated just an allocation to gold in those periods. Gold's role as a diversifier was still very, very prominent. And in those times, you know, we had things like the Eurozone crisis, we had the tech crash and so on. And so you still had benefits coming from a gold allocation at those levels of 2 to 5%. And that's another reason why we wouldn't recommend going sort of to the 10-20% allocations, because if you do experience another sort of lost decade, you're not sacrificing overall portfolio return to get that diversification. So it still stacks up even when gold does nothing. And I think that's an important point to make at this time when gold's at record prices.
That white paper that Clive talked about, State Street have given us a copy, and that's circulated to everybody, or will be circulated to everybody who's registered. Other questions? Yeah, Rob.
Thanks. Just a suggestion to the producers of product out there. There's a new strategy you should work on called GARP, gold at a reasonable price. So I look forward to an ETF on that. I'm interested, following on from that particular comment, I wonder if you substituted T-bill for gold through those periods, that would have been equally a diversifier, because really the diversification was gold wasn't moving when everything else was moving around it, and T-bills don't basically move in their capital value. Same with bank bills here or whatever. So there's an idea there that gold's diversification benefit is certainly there, but there are other things that can provide that benefit. But what I'm curious about right now, it strikes me, there's a couple of things going on. One is the taxi driver phenomenon, like a stock bubble is one indicator is the taxi driver's giving you stock tips, right? In gold, that equivalent indicator queues along Martin Place for people selling their jewellery, divorcees selling their wedding rings, pulling out their fillings and melting them down, etc. The last time I remember seeing that happen was, again, like a peak in the gold price. And both of those things also coincided with this massive uplift in price. The momentum recently is just insane. So if you look, and I've done this exercise, if you look at the 200-day moving average of gold versus where it is at that point in time, the difference right now is as high as it's ever been in 30 or 40 years. And the last time it was near that was, again, at another major peak in the price. So I agree with lots of the benefits that you've mentioned about gold and the supporting mechanisms for it right now. But I just wonder where we're at right now is a bit of a blow off in price where it's, I don't know how safe it is to buy at that level. So maybe you could comment on that.
I'm not advocating that you go out and buy it now, necessarily from a, you know, exactly from an aggressive point of view. But, you know, look, if you look at it currently on a valuation basis relative to other assets, right? So if you look at it on a ratio basis, because it's very hard to sort of say, well, you know, what's it worth? Outside of Sydney housing market, it's probably the most expensive it's ever been. Like, and I sort of say it a little bit jokingly because nothing's more expensive than Sydney housing. But you know, when you look at it relative to other, you know, other commodities, other assets, equities, whatever it might be, it is at the way end of the range. So, but if you then step back and sort of say, well, why? There are a lot of reasons around why this is happening, and I think that there is really tectonic shifts around the way that you're getting rewiring in global, you know, especially central bank policies, and the way that, you know, China, India, Russia are approaching the way they're going to manage their balance sheets going forward. And it was like, I mean, I saw a talk about this a while ago, because when they were sort of like trying to push a new BRICS currency sort of thing, one of the Middle Eastern sovereign wealth funds was put on the spot and said, well, would you be happy swapping out 20% of your US dollar reserves for this new BRICS currency? And they just said, no way. So where else do you go? There's not a lot of other options, and that, I think that's really what it comes to. I don't think the punters down Martin Place are shifting the price. I think it's central banks that continue to buy, and the problem is that they just say, we've been told we've got to go and buy it, and they're just going to buy it. So I can't predict when that's going to stop, but I do think that's what's the driver behind it, and it probably does get out of control. So.
Thank you, guys. Thank you, Marissa, Jason, and Clive.
Thank you very much.
Jason, I'll just take that. Great. Look, thanks very much. So, you know, this is it's an eternal asset, and it's one that's always going to be under consideration for a place in portfolios. Look, and now we're moving from one real asset to another, which is the opportunities available in the fixed income market, reflecting investment in real assets. And it's my pleasure to introduce Nigel Douglas, who will be known to many of you as one of Australia's leading independent investment consultants, to take us through this. Thanks, Nigel.
Yes. Okay, thanks, Toby. Yes, this is a major asset class, fixed interest we're talking about, and the title Income with Purpose has got a range of meanings, and I think we're fortunate to have Bill Bovington to speak on the topic. He's Investment Director at Australian Ethical, and what's important, he's a highly experienced fund manager, over 35 years experience, so he's seen a wide range of market cycles. So Bill's going to give a short presentation, unpack the topic, and then I'll ask a few questions and then open to the audience for questions. So in the interest of time, I'll just ask Bill to come up and commence his presentation. Thanks, Bill.
Thank you for that very kind introduction, and not being too specific about how many years I've been managing fixed income. So thanks, Nigel. Look, you know, I'm really happy to be here talking to you all today, and particularly about two topics that I'm very much passionate about, and that is fixed income and working for an organisation like Australian Ethical, Purpose. So I'm going to kind of like delve into both meanings of the topic, income with purpose, and taking the income part. You know, we've talked a little bit about the defensive asset choices that you have in a balanced fund, and in fixed income you clearly have the defensive characteristics of relative stability in price. You have the diversification benefits. You have liquidity, and you have income and yield. And I think that is a key differentiator when you're building portfolios where you do need sort of a regular cash flow that you can predict. The other side of things, which has really only been a component, I think, of fixed income markets for the last five years or so, is being able to invest for purpose with the fixed income assets that you hold. And that's really been the growth of the green and sustainable bond market. And I think it's one of the most significant developments in fixed income since securitization, because it really is kind of a new concept and a way to get a sort of a second benefit out of the investments that you make, which is not just the return, but also providing capital with a proviso of how that capital is going to be used, and doing it without sacrificing at all on the returns that you get from holding your fixed income assets. So I might pop forward. I think the first thing we might discuss is a little bit of context. And this always gets people's attention because we're going to look at what the market's thinking about cash and bond yields, and obviously it has a big impact on mortgage rates, so everyone sort of has a little bit of interest in what's going on here. But I think the main thing to point out is that major economies seem to be moving towards a range of 2.5% to 3% cash rates. Some are closer or further along that roll than others, and I think that's going to provide something of a mild tailwind for bonds. But I think one of the things that we have to learn to live with, and for a bond manager, I think it's a good thing, is that we're going to continue to have steep curves, because we do have that inflation backdrop, which is less benign than it has been for the last few decades. Obviously, we had the COVID interruption, the retooling of supply lines, the move towards less globalization. Now we've got sort of trade protectionism. All these things are quite costly in terms of a backdrop, and therefore mean we're going to have more persistent inflation going forward, therefore higher longer term rates, regardless of whether short-term rates continue to come down. And spreads are they're not super tight for high grade. In fact, there's still quite good value in very high grade credit, but they have got tight for what are traditionally more higher yield credit assets. And I think the combination of those two things gives, for an investment grade manager that's trying to put a diversified portfolio, it does produce some interesting opportunities, because the steepness of the curve and the ability to still get paid relatively well for high-grade credit gives you what we call a really nice roll down, because assets in fixed income actually mature, and as they get toward cash, particularly with a steep curve, they get repriced at a lower and lower yield, and that gives you a kind of a capital gain, a persistent capital gain benefit over and above what you might get from just looking at the running yield of a portfolio. In terms of choices in the fixed income market, obviously, and this graphic is a bit stylized, but it gives you an idea of why you're getting high yields as you step out the curve here, from cash into term deposits, into floating rate credit, fixed rate credit, diversified credit, into private credit. And private credit clearly is a very broad church, and can include things that are kind of equivalent to a diversified debt or credit portfolio, but also can be much more at the higher risk part of the spectrum. And what we're seeing as we move up this sort of yield spectrum is increasing different kinds of risks. So it might be just purely market risk. You may still be in relatively risk-free assets, but you're getting more mark to market because you're having longer maturities and therefore duration risk. or it might be additional credit risk, or it might be additional liquidity risk, or it might be all of those things. So where does green and sustainable bonds fit into this spectrum? Well, it's represented right across the spectrum through green and sustainable loans, right down to short-term or floating rate green assets, green mortgage-backed securities, for instance. So what do we mean by sort of green and sustainable bonds as a marketplace? It's still relatively new, and I think it's conceptually pretty easy to grasp, but it's a little underappreciated, and there have been some, I guess because it's a new market and it's been developing and maturing, there are still some misconceptions about it. So the first thing to note is that it is a mechanism for issuers to come and to have a structure in place which is agreed by market convention, which has a number of characteristics to it, and will allow a borrower to come to, or an investor to say to a borrower, here is capital for a set period, for a set return, and a proviso of where that capital is going to be applied. And typically, it's applied for some of the most important challenges that we have globally at the moment. So things like addressing the sort of mitigation and adaptation issues around climate change, looking at food and energy security, looking at social housing, so a whole bunch of things that need to be addressed. And there are bonds that have been issued specifically to address those things. What's important about the way that this market is put together is a set of characteristics which allow for a degree of, I guess, oversight and engagement that bond managers typically have never had before. And what I mean by that is that there will be, through the agreed accreditation processes that bond issuers go through, which is set out by the International Capital Market Association, there is a framework which is now become quite well established in markets, and a verification process through entities like the Climate Bond Institute, which allow for a degree of certainty and confidence about the way that these markets operate. And we've also recently seen, in Australia, for instance, the government's working groups around a taxonomy, which looks at what kind of activities are appropriate to go into these kind of securities. And again, to give that kind of integrity and confidence to the market. And lastly, it's all around the reporting, because you are going, you have an expectation that these projects and these assets are going to come to fruition. Well, you want to be able to see that reported back to you, and you want to be able to see the impact of that, that funding and those projects as they mature. So that's really important about the integrity of the market. Just a little bit about the issuance and so forth. I mean, it's been really interesting. Obviously, globally, there has been a change in the winds with respect to the embracing or otherwise of sustainability as a concept politically and in financial markets. But nonetheless, we are still on track to have another record year of issuance globally for sustainable and green finance. And indeed, similarly in Australia, we're going to probably approach 50 billion of new issuance in this market for this year, going across all both local and international issuers that come to this market, like the World Bank and ADB and so forth. So again, it is a thriving market. It's making records pretty much every year. It's growing in diversity and choice. Importantly, though, what it does for your portfolio is that it still gives you all of the characteristics and benefits of your typical defensive fixed income allocation. And you do that without being able to, without necessarily sacrificing return. I think we are potentially going to talk a little bit about greenium, which was a term that went around about particularly early days in the European market in particular, where there was insufficient supply of green bonds, and there was a benefit to those issuers who are early in and supplying that latent demand in terms of lower borrowing costs. But that isn't the case anymore. I think, as I said, engagement and reporting is a real necessity in this sector because, again, there is a certain expectation of the investors into those bonds that they are going to get what they sign up for. And you can't therefore do it on a passive basis. And I think, you know, we've obviously seen the damage that greenwashing has done to the sort of reputation of this market and the degree to which it's really important to have proper integrity and transparency. And it's incumbent on investors like us to maintain the engagement with issuers to make sure that they actually fulfill their obligations. Just give it a bit of a tangible example here. You know, what are the kind of things that get funded for a sustainable bond? Well, looking at the New South Wales Treasury Corp Sustainable Bond Program, yeah, that's delivered things like the metro and our light rail. And they are pieces of infrastructure that I think really move the dial. You know, there were lots of people sort of pretty excited about going for their first ride on the metro. It was great to see something, you know, that was kind of state of the art and built for sort of an urban environment and to improve the urban environment and to kind of address some of the issues that we have as a country. So, yeah, that's the kind of things that go into this. And I've never, you know, in terms of the normal bonds that I've held over my career, I've never had a connection like that before. I think it was great. You know, my son-in-law sort of come up to me and said, oh, you know, it's really given me sort of, you know, cause for hope that we can actually deliver on some of these things that make a difference in people's lives. And I guess the last thing to say, I guess, is, yeah, how does it work in your portfolio? Well, increasingly, there are products out there that are like plug and play. They'll be managed for you so that they effectively are just a traditional bond exposure against a composite bond index, for instance. And the active management risks around that and the construction, you know, is still looking to add value well over what the index is providing. And it's able to do that, particularly as now we have full sector a full sector choice. We didn't have any Commonwealth bonds before the middle of last year. Now we do. That's a real kind of advantage to us as an active manager in terms of doing sector rotation and so forth. And in fact, you know, for us and other managers, it's given us more confidence about the future of this market and allowed us to actually increase the investment expectations or investment objectives on our products. And it's also allowed us to bring down the tracking error to be in line with other active fixed income products. So I think it's very much coming of age, and it's going to be a ongoing, vibrant. I mean, there's some estimations that there's 6 to 10 trillion of finance needed just to do the energy transition globally over the next 10 years. And a lot of it will come through these green bonds. So it's going to be a growing and key component of fixed income markets globally. And I think it's, you know, it's something that will be increasingly either a part of people's portfolios through their conventional funds, or if they want to have more of an impact kind of component towards their portfolios, that they'll go into a specialist fund that has specifically targeting these labelled bonds. I might pause there because I've gone over quite a lot, and we might take some questions.
Bill, all right, now that's definitely working. Okay, you covered quite a lot there. I think it's just important to remind the audience that, you know, you can create a core Australian bond diversified portfolio in this sustainable bond, green bond sector. It's not a niche investment. So my first question is actually, won't be on the greenium because it sort of covered that, but we might go over it again to remind people what greenium means. It's not just a trendy expression. But on the income side, in terms of the income received by retail investors through distributions in the current market, so we talk about actual numbers here, what can reasonably be expected, you know, from this sort of diversified portfolio?
Oh, yep, here we go. Look, I think if you look at a diversified, you know, fixed income portfolio, like our green bond fund, for instance, it has a running yield of around 4.5%, and that sort of goes up a little, down a little, and that's just the starting point. So you've got the 4.5% there, which you know makes it sort of maybe a little higher than term deposits, similar. But there are some, as I said, there are some sort of structural things that are available to you in the fixed income market, which make that running yield just the starting point. So if you look at, for instance, the last year interest rates, I think, have bumped up to around an extra 0.25% from where they were previously. So that's actually shaved about 1% in terms of capital return off of that 4.5% that you're getting as a running yield. But if you're invested in credit rather than in government, that's an extra 1 to 1.5%, which offsets that.
So what's the average credit quality?
Yeah, average credit quality is still AA.
Right.
So it's still
above investment grade, right?
Yes, yeah, well, yeah, absolutely, yes. But you also get that roll down, as I talked about before, which is because we've got a steep curve and bonds get older or younger, go to maturity. Then you get about 0.5% out of that. So all in all, if we look at the portfolios that we follow, you know, they've been giving sort of 5 to 6% return consistently over the last 3 years, and that's after fees, and you know that's giving you an active return of 75 to sort of around 75 basis points, which again is that the target that we have is 0.5 to 1% as an active return.
Right. As the last session reminded us that we're in a volatile world.
Yes.
And one of the challenges that I've observed over many years with Australian fixed interest managers has been their inability to deliver consistent value add through duration management. So what do you think is going to be required, or what are you expecting in terms of the way you run portfolios to deliver that duration return?
Look, we've always had a pretty successful run on our duration management. There are times where it does become more difficult, and I think in particular when governments were pursuing a zero interest rate policy and effectively having a micromanaged bond market by buying through quantitative easing.
Yeah, that period of zero interest rates, that lasted, what, 4 or 5 years?
Yeah, it was quite a lot.
And I think there was something like 13 trillion US negative yielding bonds globally, right? So very tough way to manage duration.
And that what you get in that environment when you're faced as a bond manager with buying and holding an overweight position in bonds, as the yield gets to zero and goes negative, you really have to be able to hold your nerve, particularly because, you know, you're managing to actually protect the downside for people as well. So I hope we don't see a repeat of that environment, because that is a...
But you wouldn't expect a repeat?
No,
okay.
Absolutely not. In a normalised environment like this, lots of opportunities for bond managers. And I think that is borne out if you look at how well bond managers in general have done over the last 3 years. It's been a good time for active management.
Yeah, although they have had the benefit of a favourable credit environment.
Correct,
right?
yeah.
Just on the issue of return to retail/wholesale investors after fees. I mean, as you indicated, a fair degree of skills required in this green sustainable bond area, fixed on top of the normal fixed interest skills that are required. So, you know, are fees expensive? I mean, for managers in this area compared to say, well, we've got these days plenty of, as we heard earlier too, about ETFs and smart indices, etc.
Yes. Well, look, I think it really depends on the I guess the legacy of the product. Some of the older products that were put up were built in a situation where they didn't have scale and they had additional costs, were quite expensive. More latterly, and particularly looking at the range of funds that we manage, they're very competitively priced. And that's because there is scale and we're able to tap into the ESG and ethics team that services the whole organisation. It isn't all just put on the one product and the one asset class.
Right. And just finally for me, you talked about being more actively engaged with issuers. Like we're talking, the counterparties can be sovereigns or semi-sovereign or whatever who are quite powerful. How do you ensure they're spending the proceeds the way they've stated in the issues?
Yep. Well, there is verification. I mean, look, you know, I don't think it's usually much of an issue around them meeting the requirements of the specific issue. One of the more difficult things is ensuring that in context, what they're doing with the funds from this one bond issue isn't being blown out of the water by all of the other activities they undertake. So that's something that we need to do. We certainly don't hold every green bond that gets issued, and that goes for both companies and sovereigns, because there are times when their actions make their green bond look like tokenism, in which case we don't want to hold.
That's a good word, tokenism, yes. But we don't want to see that. Just time for a couple of quick questions from the audience.
I have a question, Bill, which is that as we go through the sort of electrification process in the economy, we're going to see a lot of issuance, particularly of debt underpinned by the sort of utility argument. Not all of those projects are going to work, and it seems to me there's a good deal of uncertainty about whether the entire electrification project itself is going to work. Power prices in Beijing, 8 cents a kilowatt hour. Power prices in Sydney, 35 cents a kilowatt hour. This is not a sustainable model. So, long-winded question. How do you assess the sort of long-term viability of some of these projects that are now being brought to market?
Well, I probably should have made that a little clearer. Green bonds, as they're constructed for wholesale investors like us, don't fund specific projects. So you don't end up with an exposure to a solar farm or a wind farm out west somewhere. You actually are exposed to the issuing entity, which might be a state government, and it has exactly the same credit quality as all of the other state government funding, or it might be through a bank. Quite often the banks will fund a portfolio of projects, get appropriate diversification, and then issue in the bank's name with the bank's credit quality. So you don't have that issue. But I do think, as you said, electrification is going to be a significant part of the capital call, and it really needs to be. I mean, look at all of the ambitions around data centres globally and the amount of power that needs to be provided for that, and working as they do on a sort of 3 to 5 year time frame. There isn't any traditional power sources that can be deployed in that kind of time frame. So if they want to power these data centres, it's got to be done through renewables.
Other questions before I ask whether Bill would fund small nuclear reactors. Bill, would you fund small nuclear reactors?
Not currently. Untried technology, yes.
Bill, just we'll go back to the greenium because it's a buzzword that was floating around a few years ago. But I think it relates to this income question, because if there is a greenium, which I'll get you to explain a bit what it is, that would lower running yields and therefore be contradictory to the income objective. If you compared this sort of portfolio against just a regular portfolio that didn't have a green sustainable focus. And if it was significant, then, incomes will be a lot lower, right?
Yeah, well, let me put it in context. Initially, and I think where the concept of greenium came was in the sort of early 2000s, when 2020s, when the green bond market in Europe was needing to satisfy a whole bunch of additional ESG focused products, and there was definitely more demand than supply, and there was quite a poorly constructed academic piece which looked at effectively broke up the indices between labelled bonds and non-labelled bonds, and didn't properly control for credit quality and duration, and just looked at the difference in yields and said there's a greenium of 20 odd basis points, which was enormous. When you actually look at paired bonds, so bonds issued of the same maturity by the same entity, there has traditionally only been 1 or 2 basis points difference, if there is a lower margin on the green bond, and that was justified by issuers by saying, well, they have to construct and do all of the reporting, and they have additional costs associated with it. However, that has now disappeared as well. So we look at Copenhagen Business School just put out the very latest research on this at the end of June, and they said they think there's actually a cost to the issuer of issuing green bonds at the moment. So
that's a good point.
Which is good for investors.
Just quickly, the Commonwealth's just, as you said, just commenced their program.
Yes.
What's the scale of that program? And because they've got a lot of debt to finance, right?
Yeah, they do. They have slightly less projects that they can apply to than the states. So the states are still going to be the biggest issuer in this space. But I think the Commonwealth's now got about 10 billion. I expect that they'll continue at that kind of pace, 5 to 10 billion a year, but that will grow up their lines. And they've got obviously a role to play in catalysing investment through the Clean Energy Finance Corporation and so forth.
Okay, great. Look out for that. Okay, I think
No, we might just call it quits.
Call it quits.
Okay.
Tea time, I think.
It's tea time.
Okay.
Yes.
Thank you very much.
Look, please join with me in thanking Nigel and Bill. We're going to take a short break now for 10 or 15 minutes to move outside, and they'll reset the tables. Coming back after this, we'll have lunch, and then we'll engage in a bit of analysis with Milliman's on what a balanced portfolio should look like and what the risks are to that balanced portfolio. Then we'll have another session with Better Shares and then Alan Kirkland. So take a few minutes and we'll come back in sort of 15 minutes. Right, let's get going. And what have we got on? Okay, this session now with hosted by Simon Ho of Millimans is, as I said, an opportunity to analyse what's actually in balanced portfolios for managed accounts. So we did a survey of advisors, asked them for their asset allocation, and back came the results, and Simon will talk about those. Somebody dropped an opal card outside, so there is an opal card. Okay, it could be Matt. And if it's not, he's going to check whether there's any money left on it. And yeah, so now let me welcome Simon Ho from Millimans. Thanks.
Thanks, Toby. Sorry, what I... All right, great. How are we all? Good? All right, it's a pleasure to be here today to host today's session on capital markets outcome. Let me just try. So, sorry, Toby. This is the thing? The green button? Okay. Sorry, let me just try this out while we're here. Okay, all good. For those who don't know me, my name's Simon Ho. I'm one of the portfolio managers at Millimans financial risk management business here in Australia. So Milliman is an actuarial consulting firm with about 5,000 employees worldwide. And the FRM, so the financial risk management business, have been operating for about 25 years and over. And we predominantly serve institutional clients to help them manage their financial market risk on the balance sheet. And we also manage our own managed accounts portfolio as well, called Smart Shield, which aims to deliver managed risk investment solutions for clients such as retirees and pre-retirees. And so as part of this work, we deal a lot with data and quantifying risk and so on and so forth. So for today's session, we've applied some of those data-driven lenses to, as Toby mentioned, one of the asset allocation surveys that we sent out a couple of weeks ago. And the aim was to better understand how the different asset allocations differs across the different balanced portfolios that advisors hold, as well as gather some views on some of the key concerns that some of the investors have going into next year. So in this session, we'll explore the impact of a range of the survey's asset allocation on investment outcomes from a historical backtesting perspective. And given our background, we'll also briefly touch on how risk management techniques can add an extra dimension to managing portfolio risk. And then I'll hand it over to Michael Karagiannis and Jason Petris, who will share their insights on balanced portfolio positioning and outlook. And then we'll wrap up with a roundtable discussion on some of the key themes and challenges that you guys see ahead in 2025 and 2026. So we're fortunate to have two excellent panelists with us here today, Michael Karagiannis, who's the head of Jana Wealth, and Jason Petris, who's the Director of Investments at Resonant Asset Management. So please join me in welcoming Michael and Jason to the stage. So without further ado, let's start off with the survey results before I pass it on to Michael and Jason to share their insights. Disclaimers, don't worry about that. More disclaimers. Okay. So yeah, just wanted to give you guys a quick overview of what the survey looks like in case you haven't filled it in. So respondents basically fill out their asset allocation across the various of asset classes for their balanced portfolio. And based on these asset allocations, we'll run analytics on the collective investment outcomes and risk, which we'll touch on in the presentation. And we'll also generate a tailored report for them, comparing their portfolio against the the average portfolio across some of the key performance metrics. So let's start with an overview of the asset allocation from our survey respondents. So here, just a bit of legend. The blue bar represents the mean portfolio, and then the grey bar captures the 25th, 75th percentile for, I guess, to capture the range of outcomes that we've captured across the survey respondents. So as you can see, quite a wide range of allocation, but on average, respondents have about 63% in growth assets, out of which we've got around 25% in Aussie equities, 26% in global equities, about 3% in emerging markets, 3% in listed prop, 4% in infrastructure, and 2% in private equities. And on the defensive side, we've got average allocation of 20% in Aussie fixed income, about 8% in global fixed income, and 3% in others, such as gold and alternatives. So just one interesting observation I wanted to point out is if we just zoom into the global equities bar, and then there's an arrow that points rightwards, dispersion in global equities looks fairly typical, but quite a large dispersion when you actually zoom in and look at it from a currency hedging ratio perspective across or within global equities. So that kind of shows you a differing view of the respondents on how much of their global equities should be currency hedged or not. So quite interesting, as we're also currently seeing in the market a narrowing of the cross-currency basis of the Aussie dollar, which means that it's more and more expensive to hedge the AUD out. So in other words, we're basically compensated less and less now for taking on added volatility from having a hedged global equities position. And then also just wanted to draw out a few high-level observations as well. The first observation is we'll see a majority of respondents ranging from 52% to about 65%, from the 25th to the 75th percentile range, with average around 63%. So if we compare this to a Morningstar benchmark, then the average growth asset, is around 51%. So the average balanced portfolio here from the survey respondents, according to that, shows a bit of tilt towards growth assets. And then the second observation here is we also see a slight tilt towards domestic equities as well. The chart here shows the proportion of equities that's invested in Aussie equities, which is highlighted in grey, and then global equities highlighted in dark blue. So from the survey, we see approximately 46% to 54% split between Aussie equities and global equities, which is materially higher than representation in ASX in the MSCI World, which is about 2%, and also higher than the equivalent in the Morningstar Target Allocation Index, which is 40% in growth assets. So we believe that there's a home bias, obviously, and it comes from, I think, a few factors. One is familiarity to local investors. It's also could be a potential better hedge for local inflation as well. And then also, I believe there's also some peer relativity considerations in there as well. And then lastly, franking credit, which is worth about 1% per annum to retirees, so not insignificant. And then this slide, I'm just impact of, so this slide, I think we just took the asset allocation provided by each respondents and basically plotted the investment performance across the past 20 years. And then we also made the assumption, for simplicity's sake, that the different asset classes are invested in a passive index. So there's no active alpha in there for simplicity's sake. And then through this, we wanted to observe how each of the different asset allocations will perform under the number of sort of market cycles throughout the past 20 years. So in this chart, the grey line represents the cumulative performance of each respondent, and then the dark blue line represents the mean, or actually the median portfolio. And just a couple of interesting observations to highlight here. For the first 5 years until the end of the GFC sell-off, you probably can't see my cursor, but yeah, so if we look at the first 5 years and then we've got a GFC sell-off there, there's a variety of how the sort of the portfolio travels up and then down, but we generally ended up at the same spot after the sell-off. So we either sort of outperformed during the bull run, leading up to the GFC, and then underperformed during drawdown, and then vice versa. And then also observation 2, ignoring the outliers. If we again focus on the 25th percentile and the 75th percentile of the range, we see that the return ranges from about 6.4% return per annum to about 7.3% per return per annum, which isn't huge given, you know, the average fee for a balanced fund is around 90 bips. And also the max drawdown, which is, I think, the last line in the table, differs moderately as well, ranging from about negative 27% to about negative 32%. And most of that came from the GFC period. I think it just goes to highlight that, you know, why diversification is a great tool for allocators. During sort of large market drawdowns, the asset class becomes more and more correlated. Just something to be aware of. And then this slide just sort of zooms in on the two on the investment outcomes during GFC on the left and COVID on the right. Yeah, so we see, as previous slide, GFC, the max drawdown from the respondents varied from negative 27% to about negative 32%, and then COVID's about negative 21% to about negative 23%. So variation tends to be narrow due to the positive correlation during crisis times. So it might lead to a natural question, I guess. You know, how does one manage these market risks aside from diversifying your portfolio? And one of the potential answers could be explicit risk management, which sort of goes to heart to what we do at Milliman, and that sort of nicely segues me to the next section, which is the impact of explicit risk management on our respondents' portfolios. Yeah, so there's a number of ways to managing risk, and here we highlight 3 common approaches. The first one is de-risking, which is probably the approach that's familiar to most of us. And that is, for example, you move your clients from growth assets into defensive assets when they move into retirement phase. And, you know, this approach, whilst we're expected to take away from the downside risk, we also expect to take away from the upside gains as well, in a symmetrical fashion. And in general, when we model going down the risk spectrum, there is a cost to de-risking over the long run. So according to the Milliman standard scenarios generator that we generate in-house, there's about a 1% per annum less in expected returns when we go from growth portfolio to a balanced portfolio. And then the chart in the middle, a cap and floor, is also quite a popular strategy in the US, maybe less so here. But the idea here is the portfolio will purchase a put option on the portfolio to basically provide a hard guarantee on the downside. But in order to manage the cost of this guarantee, the upside is typically capped as well. So this means that whilst the strategy will do well in bear markets as well as sideways markets, it tends to sort of be capped on the upside when, you know, we have a strong bull run like we did in 2024, which may or may not be a hard conversation to have with clients when, you know, the upside is capped. Which brings me to the final approach on the right chart, which is the strategy that we use within the Smart Shield managed accounts, as well as what we've used here as the risk management overlay for the next few slides. And the idea of this strategy is to provide a cushion as opposed to a hard guarantee on the downside. And we do this through trading futures to replicate a put option as opposed to actually purchasing a put option. A, it's cheaper, and then B, it's more flexible in adjusting to the portfolio's parameters. And aside from doing that, we also manage the portfolio volatility through to a target level through trading the futures as well. Yeah, so because we're not paying for a hard guarantee, the upside's not capped as well, as you can see from the blue line on the chart. And so this means that we can still deliver good growth potentials in benign bull markets. So let's take a look at how it fares in a drawdown such as COVID. I think before that, one thing to note is we don't usually just slap on a managed risk strategy alone because there is hedging cost involved in that. We usually also up the portfolio's growth assets as well, so to make a growth asset tilt to cover for the costs associated with these hedging activities. So in this chart, what we see in general is that the managed risk strategy provides quite a decent amount of cushioning during the COVID for a balanced portfolio, so reducing the drawdown from -24% to about -17%. And then for portfolios with a higher allocation towards growth assets, such as a growth portfolio, high growth or aggressive portfolio, the cushioning would be a lot greater, given that there's a larger allocation towards equities, which will be risk managed. And we also saw a decent amount of volatility reduction as well, which I can't quite read because I'm short-sighted, but I think 39%, I'll try, from 39% to about 18% reduction, which is quite decent. And then similarly to the GFC as well, we saw the drawdown reduce from -31%, which is the grey line, to about -17% when we apply risk management on top of that for the average balance portfolio. And also that's accompanied by a substantial reduction in portfolio volatility as well, from 13% to about 6.7%. And then lastly, just wanted to touch on the flip side. You might be interested during a bull run, how does it work? So during bull run like 2024, we've had quite a minimal amount of hedges on, and we've had an asset allocation tilt towards equities at that time to offset the cost of hedging as well. So which means that there was very little impact to the portfolio's performance during the bull run in 24. Essentially, this was a period, where volatility was muted and hedges was turned off. So yeah, hopefully that gives you guys, a few snippets of the survey and its results. I'll now probably turn it over to Michael first, and then followed by Jason to talk about their views on what a balanced portfolio should look like and the things that we should watch out for.
Yes, thank you very much, Simon. So I'm just going to give a brief overview of Jana's perspective on balanced portfolios. And I guess one of the things we always have to be conscious of is definitions. Balanced portfolios mean a lot of different things to different people. I've seen portfolios that are 50-50 growth defensive referred to balanced. I've seen 65-35, which I think is close to the context that we're talking about here. The balanced term itself is quite misleading because, of course, anyone who has observed the performance of a 65-35 or a 70-30 portfolio over time knows that as far as risk is concerned, it's largely being driven by the growth asset exposure, the equity exposure, and I don't think that necessarily qualifies as a definition of balanced. So we tend to not refer to balanced ourselves. We tend to refer to the actual growth defensive exposure within the portfolio. So with that in mind, what we've done is actually modelled out what one of our 70-30 portfolios have done. Obviously, we've been managing institutional money for a long period of time, wealth money over the last 6-7 years or so. And if you look at this chart, you can actually see some lines there. The really squiggly line is the 12-month return, which you can see is all over the place. And particularly volatile as we've entered into the 2020s, firstly with the sell-off associated with COVID, and then we've had more recently the sell-offs associated with other areas of geopolitical risk and so on. And so it's been a fairly volatile ride over the course of the last few years. Over a longer term, when we try to smooth that out, and we're looking at numbers here, it's a 5-year number. A 5-year number, and then we've got a 10-year number, which is the flat line. What you've seen, in fact, when you even out those periods of volatility, actually the performance of a 70-30 or 65-35 type portfolio has actually been pretty reasonable. It's delivered something on average of about 7 to low 7% annualized returns over a 10-year period. It's actually been a fairly virtuous cycle, notwithstanding that there's been some fairly wild swings and roundabouts associated with that. You look at the objectives often assigned to these portfolios, CPI relative objectives, that's actually delivering, given the backdrop on average through the period of probably CPI around about 2.5%. It's been a little higher more recently, but on average about 2.5% over the journey. Then you're talking probably about a CPI plus 4 to 4.5% return, which is actually a pretty reasonable outcome. Our concern is not so much that, it's just that that's probably going to be much harder to sustain moving forward, where you're going to have normal or above normal volatility by virtue of various factors associated with, increasing geopolitical tension, uncertainty about economic cycles, the impact of tariffs and so on and so forth. And the backdrop of a lot of the driving asset classes, in particular the growth asset classes, are that we're starting from a point now that they're not particularly cheap. And in fact, you can argue that some are quite overvalued at this point in time. So moving forward, and I'll show you some numbers on this, it does look to us like it's going to be a situation where it's probably going to be a little harder to get that CPI plus 4 to 4.5. We might be talking about CPI plus 3 to 3.5% returns for this type of portfolio. In terms of the asset class views, just looking across the various asset classes here, we've got Australian equities, which we actually think is probably one of the lesser attractive asset classes at this point in time. I won't spend too much time on that, but basically the forward-looking expectations about earnings in Australia are not particularly attractive. There are large parts of the market here, particularly the banking sector, that are trading at extremely lofty multiples against fairly mediocre earnings growth. And so, we've seen this very concentrated growth in the market here, which we think is going to be a little difficult to sustain. So, we believe that probably there are better markets available than the Australian equity market. Global equities, on the other hand, fairly neutral, but that really, I guess, disguises a lot of regional variation, and indeed within markets like the US, enormous sectoral variation where there are pockets of extreme excess and perhaps other parts of the market that aren't quite as expensive. When you even that out, we're fairly neutrally positioned in terms of global equities at this stage. Next, I think we're talking infrastructure and Toby, we really need to get it up here. I'm sorry. Can anyone read that one? I can't see it. I'm sorry. This is the problem of inheriting someone else's slides. Fairly neutral on infrastructure and property. And over the page, Australian fixed income, we actually think while Australian equities are expensive, Australian fixed income could actually be somewhat of a safe haven in a fairly unstable capital market environment where there's a lot of focus on increasing debt in many countries around the world. Australia government debt is not really a problem at this stage. And certainly there's no significant geopolitical risk. We're not having shutdowns of the federal government here, as we're seeing in the US at this point in time. And probably the only other one that I want to draw attention to, where probably we have reasonable conviction, is in regard to the Aussie dollar versus Forex, which really in most portfolios is translated into the hedging ratio. Now, historically, in an environment of uncertainty, you would tend to, and we would certainly normally recommend running much lower hedging within portfolios, because if there is an equity market correction, what tends to happen is the Aussie dollar takes the impact. It acts as a bit of a cushion on returns, and you tend to find that global equities unhedged do relatively well. We've seen that during the GFC. We saw it during COVID. We saw it more recently in the bond sell-off in 2022. We're in an environment now, you also have to bear in mind that over a long period of time, the US dollar has gone through secular trends of uplift and downlift, and often they have been driven by geopolitical agreements or disagreements, significant trade impasses that have occurred frequently. We've gone through a period of the last 20 years or so that the US dollar has actually been in a fairly favourable environment. It's been a preferred currency. But now we're starting to see the cracks appear. And one of the themes that's developed over the course of the last year, and perhaps it's related to the change of administration, is less reliability, I think, as to the role of the US dollar in a global context. And given that it makes up 60-odd% of a global equity portfolio benchmark, our view is that this is probably one time where you actually want to run overhedged portfolios, notwithstanding the risk backdrop, because we think this could be a multi-year secular environment. So that's something to think about as well. And it's probably one of our highest conviction calls. It's very hard to be really categoric about what's going to happen to equity markets, but it seems as though the US dollar weakening on a multi-year basis is probably a reasonable expectation to hold at this point. In terms of the portfolio construct, this is a managed account portfolio that we run. It's sort of a reference portfolio for us. We have a lot of clients that have very different positions around this, but really just comparing it and contrasting it against the IMAP average, you can see there that we're a little bit overweight Australian equities. Now, I said we were, cautious about Australian equities. One of the things I think that is interesting in the current environment, thank you very much, Toby. That's a God save. Thank you. Very good. Yeah. I can see what I'm talking about. Australian equities, slightly overweight. But, one of the things that we are looking at here is, and I think Simon referred to it previously, Australian equities, people tend to hold an overweight exposure to Australian equities, and we spend a lot of time trying to argue against that. But in an environment where aggregate returns may be subnormal, the value of those franking credits, which are pretty constant as a proportion of, or in terms of the contribution to return, may be proportionately more important in this environment. So that tends to suggest to us maintaining a reasonable aggregate exposure to Australian equities, even if you are a little cautious about the valuation of the market itself. Global equities, you can see a significant twist towards hedged versus unhedged compared to the IMAP average. Fixed income, relatively in line. Probably the other difference there, private equity, there was an allocation in the IMAP average. Managed account portfolio is very hard to do. We've got some clients that do it within MDAs, virtually impossible to do within SMAs. If we were talking a family office client, we'd be suggesting, private markets up around 30-40% of the portfolio. You just can't do that easily, if at all, within a managed account context. So we tend to focus more on liquid alternatives in this context to try and manage risk and to try and put a floor under the portfolio. The last slide I really want to show here is in terms, and hopefully you can see this, I can now, in terms of the output from our solve analysis, which is our forward-looking asset allocation level analysis, slight overweight to growth assets versus the IMAP average, expected returns around about 6.6%. This is including franking credits, however. So on an after zero tax basis, if you strip the franking credits out, you're probably closer to 6%. And that's at CPI plus 3.5 that I was talking about. Volatility slightly above the IMAP average, and then the probability of actually achieving the returns just slightly above normal. So I guess the key theme is here, had a good run out of a 70-30, 65-35 portfolio. Don't expect it to be quite as stellar moving forward. You don't have to necessarily make heroic assumptions about volatility. It's just that markets are starting at a more overvalued level, and the expectation is that you probably have to shave a little bit off your expectations about CPI plus returns for this type of portfolio, be a little bit more realistic CPI plus 3.5 is probably a reasonable guesstimate. Thank you.
Just bear with me because I'm going to have to go back. I don't have slides. I'm just going to steal Milliman's. There we go. That's what I wanted. That's the survey results, right? Yeah, cool. So with regard to, I guess, what a balance fund is, I mean, we use Morningstar categorizations. So I'll really leave it to them to make that definition, and then we really work within that from a objectives point of view. But really what I want to talk about was mainly positioning and sort of how we're thinking about things relative to those some of those survey results at the moment. So Aussie equities, just to start with, and this is sort of like two layers of this. We run a lot of direct equities within our SMAs. So just because we might have a particular weight to Aussie equities doesn't mean that it's necessarily the whole story. So what we're doing right now is having quite a defensive Aussie equity makeup within that sort of 25 name portfolio, because we do have a pretty, I guess, wouldn't say negative, but slightly less positive view on the outlook for the Aussie economy. So we're really trying to get access to global plays that we can through the ASX, but ultimately keep it at a reasonably defensive within the domestic exposures. So even though we're at an asset allocation level roughly in line with the survey numbers there, the makeup, it is a relatively defensive portfolio. I think where the big differences probably are within the international equity space. So we do have a bit of an overweight there, but when you strip it out and you look at your standard MSCI World sort of, I guess, benchmark or allocation, we're quite heavily under that from a US perspective, and putting that into different regions such as an emerging market and more Asia focused. So what we've really found, we'd like to do a lot of data stripping and pulling apart, what's going under the bonnet. So if you look at a typical allocation into, say, an Asian type of equity exposure, one of the most common indices a lot of the funds will use is an index called MXAPJ, which is MSCI World Asia ex Japan. Anybody know what the largest allocation to that index is? CBA. So you think you're allocating into an Asian, sort of portfolio, but you're actually getting a lot of Australia through that. So you've just got to be a little bit careful about how, that is sort of positioned. And so what we try to do is go a little bit more laser focused on those country exposures. So right now we're sort of, we've got a specific Japan equity allocation. So we think there's some good things happening there in terms of regulatory changes and just the sort of freeing up of the balance sheets within Japanese companies. And then the other area which I just want to touch on was, I guess, Asia sort of large cap in general. And this is sort of back to what I also said in the gold panel, that you've got a lot of, I guess, recalibration within the global economies. And take, for example, within the chip space at the moment, or some of the technology, I guess, manufacturing that's going on in the US. As we know, sort of China's being pushed out in a lot of cases, or being barred from providing equipment. And that's going somewhere. And we all know that there's an attempt and, I guess, a want to try and manufacture within the US, but it's not always that easy. Within chip manufacturing, for example, it's probably going to take somewhere between 10 and 15 years for them to get up to the level where they have an end-to-end ability to manufacture a high-end chip. And that would probably only be about 10% of their demand to get to that point. So it's a long journey. In the meantime, there's only really one region they're going to be able to use, the US, to fill that gap of not wanting to use China, which is going to be using other parts of Asia. So if you look at chip manufacturing, for example, some of the big beneficiaries are going to be more SK Hynix, so things like Korean stock market, more of the developers of that technology in Japan as well. So that's why we sort of think you've got this money moving out, and there's a big capital allocation and build out within a lot of those sort of high-tech companies, high-tech countries as well, like such as Taiwan. So something like $500 billion is the current MAG7 CapEx spend on AI at the moment. Put that in context, that's about half of our GDP. And that's all going into, effectively build out more of the capacity. So it is quite, I think, important to make sure you know where those drivers and where that growth piece is going to come from. So more broadly within some of the other asset classes, we're pretty much underweight infrastructure, property for a couple of different reasons, but we have been for quite a while. And then within fixed income, most of our exposure is really Australia. We don't see a whole lot of point being long international bonds, given what government's doing on spending and trying to deflate their way out of their debt. As Michael said, Australia is probably in a better position. I think our debt's around about sort of 50% or 60%, so it's not too bad, but hopefully it doesn't get too far out of control. So we sort of think there's capacity there for rate cuts if things sort of do slow down. So we do have a bit of duration in Australia as well. And alts, which I was talking to some people outside before about, it sort of comes down to how you want to define an alt. So I'm not going to get into that can of worms right now. So yeah, it's interesting the way a lot of that's breaking down. And one of the other pieces I just want to mention as well was just government spending. So one of the big shifts we're seeing is I guess the US forcing Europe, Asia, Australia spend more money on effectively their military budgets. So you're seeing this quite big increase in military spending. If you look back at the moment, I think Europe is basically about to spend the same amount of what it was back in the 80s on like in a dollar amount today. So they've gone for quite a contractor journey in terms of their spending on defence, and now they're coming out of that, and that should be quite stimulatory as well from an overall equity market point of view. So that's sort of the rundown on the way we're thinking about the world at the moment, what we're seeing. So we'll do some questions.
All right, great. Thanks, Michael and Jason, for those interesting perspectives on a balanced portfolio. So before we sort of go to question time, there's just one last segment, which is a bit more interactive. So turning a gear a little bit. If we just flip back. So as part of the survey that we did, not just the asset allocation part, we also had a part on addressing some of the key concerns that respondents may have going into the new year. So I'll just flip quickly to that. So key risk factors, yeah. So this is the part of the survey which we list out a list of potential concerns, and these choices are basically listed on the screen in front of you. So I just wanted to invite you all to have a brief discussion amongst your table to talk about which of these concerns are most or these risks are most concerning to your table and why. And at the end of the discussion, we'll probably ask a few tables to maybe share their insights and ideas. So if you could designate a table leader or spokesperson, that would be great. And then we'll probably reconvene in 5 to 10 minutes, 5 minutes, if that's okay. Yeah.
These the issues that concern you, or is there something else? Seeing the table with Stuart Elliott sitting at it over there, I know there's something that concerns them. So what is it that you're worried about, or your clients are worried about? 5 minutes.
5 minutes.
Yeah, I mean, it's a big shock. Let's say that way, right? So,
Right. Okay. Wrapping up now and working out who's going to be your table spokesperson. Right. Okay. All right. Okay. Let's get some thoughts. We'll have a couple from this end, starting with the man that everybody was pointing to at this table, Ben Devonish.
I don't know whether we did get consensus, but I'm saying we did. I mean, for us, and I think we had a general consensus around US inflation being where it starts and stops as far as we're concerned in terms of driving longer term bond yields, which in our view it does have the most influential impact on the movement of money. So really anything that can sort of drive long-term yields up and, affect valuation models or affect the flow of money, whether it's to gold, Bitcoin, Wesfarmers, whatever, we feel that that is probably the most influential determinant to the tipping event.
Thanks, Ben. Stephen, somebody from your end. Right.
Sorry, yeah, Thomas from Accrue. Yeah, we were talking about monetary debasement is actually our sort of main concern in terms of what's a diversifier in your portfolio, what will maintain purchasing power in your portfolio, what will be defensive, and what role is bonds playing in that? What scenario is that actually hedging you for? Because it may maintain capital, but it may not maintain real purchasing power. So you really have to think about, yeah, how are you going to do that in your portfolio construct?
Yeah, we had three. Ned Bell had an alarming slide showing non-profit making companies in the US, and that's a warning for the tech wreck that we saw back nearly around 1999, 2000. Secondly, the geopolitical risks, although we had some disagreement there on that. Some people, well, mainly me, thought that Trump was doing some good things. Australian economic growth is a major worry. Productivity growth here is terrible. It's reflected in higher unit labour costs. And when you look at the composition of growth, it's very unbalanced. And the private sector is struggling. So there are our risks.
One more from that end, Stephen.
You want me? Look, my learned colleagues here are all a bit old, they should be retired, but we added up about 200 years of experience at this table alone. And we were into the poor liquidity at this table for lunch, mate. No red wine, no beer. Food was a bit shocking. But apart from that, we just agree with everybody else. Thank you.
All right, so now we're looking for one outlier. So this table.
I don't think we're an outlier at all. We spoke a lot about geopolitical risk. I mentioned the fact that I went to a briefing recently where Christopher Pyne was talking about a change in world order. A lot of people think that after 4 years, Trump will leave and things will go back to the way that they were. And his strong view is that that's not going to be the case, and the US won't be the kind of voice of reason for global markets. So some prolonged period of geopolitical risk. And then the second thing we spoke about was valuation risk and kind of Aussie market, global markets, and we don't know where that's going to go, but we just think that's a significant risk. So that was it.
Thanks, Andy. Simon, over to you.
Great. Thanks all for great perspective and colour. So just to round it out, this is what the survey respondents thought. So not too dissimilar actually to what the discussion here talked about. Top concerns would be valuation, so US equity valuation, Australian equity valuation as well. Geopolitical risk is a big one. Inflation's also a big one. Economic drivers and economic growth being top concerns. So that's aligned. And then interestingly, I think people are a bit more concerned about the US than they are about Australia in terms of survey respondents. So take it for what you will. Yeah, so just before sort of handing it over to Michael and Jason to talk about their views on the key concerns, I just wanted to just quickly run through and give some sort of quantify some of the economic concerns that we sort of talked about here, how it affects return distributions and the like. So it's a model that Milliman has attempted to sort of explain the economic drivers and connect that to asset class return distribution. So things like inflation, population growth, GDP, consumer confidence, and the like. So here we've used developed markets, large and mid-cap, as an example. And we start with the base case, which is the left column, which is defined as under a normal real GDP, which is greater than 0.5 year-on-year growth return, and a normal inflation of between 0 to 3% per annum CPI increase. So under that, what we see is the expected return for developed markets is predicted to be about 10% for the year ahead. And then if we move on to, tackling, say, geopolitical risk, with tariffs, we talked about debasement as well. So if those things eventuate into higher inflation, then what we see is, unsurprisingly, a decrease in the expected return. And according to the model, it's about from a 10% to about a 5.4% decrease. And then we also see the tail, which is represented by the 25th percentile, also elongating as well, being negative 6.3%. So in general, a sort of a shift from to the left of the distribution. And then economic growth, so which is the third bar on the recessionary scenario, we see a expected return reducing to about 3.5%, and also equally long tail in the left side as well. And combining those, if we see a stagflationary type of event, combining the first two, then what that means is an expected return of about flat to negative 0.1%, and then a large sort of left tail distribution. So with that, I might just ask Michael and Jason if there's any sort of added color or insights that you guys have on the key concerns that people have.
Okay, 3 minutes. I'll give you the other 3. Yeah. Cool. So just bear with me on this. There's a few dots to connect, but so I absolutely agree with Stuart's table that debasement side of things is very real, and I think we're seeing it in a small sort of sample. But if it did accelerate, and I think governments are ultimately, US government in particular, is probably going to try and do it in a pretty stealthy way. That basically we're not as sensitive to it. You don't really want to come out and do it in an aggressive way or be open about it. So, and they may thread a needle, right? So they may be able to guide their way through this to basically inflate their way out of a debt issue. But it is a pretty big debt issue, and it's probably not going away. Now, if Trump doesn't really get his way, or just generally Congress or whatever it is, if the establishment, the political establishment there, get to the point where they feel they're not getting progress, and you do get politicization of something like the Fed, where they actually take control from the government and say, right, we're going to now cut rates very aggressively. We want to take them down to 1% or lower. The really scary scenario there is the Ben's table, the 10 years go absolutely ballistic, right? So that scenario where they get it wrong and they can't engineer a debasement or a subtle debasement, and it turns into an outright, run on treasuries, basically on 10 years and even longer dated treasuries, that would be a situation where then you've got these portfolios like that are in a real mess, because you don't want to own any long-term bonds in that scenario. And there's a lot of long-term bond out there, as we know, because they've issued it all. So that would probably be the pieces that sort of combine into like probably personally my biggest concern. Our broader investment team's probably got different views collectively on that, and different pieces, but that's sort of where I see it going wrong anyway.
Yeah, no, we were talking about the issue of debasement and the potential flow-through impacts of that while we're in the table sessions. But I think, we fundamentally, portfolios like this are driven by the equity risk beta, and I've talked about that with a 65-70% growth portfolio. Your contribution to risk from equities is up above 90%. Hence, my questioning whether it's really a balanced portfolio. But the balance to the portfolio is meant to come from the fixed income component, and you can construct scenarios over the next few years, for example, a recessionary scenario, where you do actually get a diversification benefit from longer dated treasuries, Australian government bonds. But you've got to be careful, because a lot of people lump in credit within that. And, obviously there's a strong focus on private credit at the moment. A lot of people have, high yielding credit within their portfolios, whether they know it or not. they tend to behave like equities in distressed environments. So, you know, when people say fixed income isn't doing its job, well, hang on, what have you actually got under the hood in terms of fixed income? But if you had a pure bond, government bond versus equity portfolio, then in a deflationary environment like a recession, you'd get some risk balance in the portfolio. The danger is, of course, that we get a scenario like we're just talking about here, where actually the volatility is driven by a continued rise in bond yields, because then it's the escalation in the risk premium in the bond market that's actually feeding back into the equity market, and there is no diversification from that. So then the question is, well, how do you introduce more diversification within portfolios? And, you know, if we were dealing outside of a managed account construct and the limitations of that, I think it's about trying to get more alternatives into the portfolio that have less correlation with particularly equity markets. And that might include, you know, extend to private equity. It might include, you know, less liquid infrastructure, property, and so on. And that's effectively moving more towards an endowment type structure, which is designed to have a lot less volatility through the course of the cycle. So I think one of the challenges for building portfolios in the wealth space, and particularly for managed accounts, is how to get that sort of similar sort of effect with the building blocks we've got today, and what building blocks can we actually get fund managers to bring to market that are reasonably going to produce that sort of result for us in portfolios, because very simple bond equity portfolios can be shown to break down in some of the scenarios that we're talking about quite badly.
Thank you, Michael. Thank you, Jason. I think that's it. So that's all we got. Quite a jam-packed session, but yeah, open to taking questions if anyone has any.
Yeah, one question. Yep.
That breakdown that you spoke about, Michael, just at the end of that statement, is that similar to what happened in June 22, where we had bonds and equities both down 10% in 1 month? Thus, in July, that following month, AFR coming out and saying, is the 60-40 portfolio dead? Is that a similar context to what you've just mentioned?
Yeah, I mean, effectively, it's a similar sort of situation. Obviously, the starting point at that point in time was sub 1% bond yields, and you know, duration commensurately increases as bond yields decrease. So the capital effect was absolutely dramatic. You got equity-like volatility out of government bonds in that circumstance. We have seen it before. I think it was 96, the great bond sell-off at that point in time. So it does happen periodically. We just tend to not retain memories of it. But we are in an environment, certainly it would not be hard to construct a scenario where US Treasuries, you know, move towards 5-6% in that range. And given the fine tolerances in the equity market from a valuation point of view, that could start to create some real headwinds.
Yeah, I mean, I agree that there was that was that scenario. We were off probably a much lower base than we are now. I mean, that was always going to be a painful adjustment to come from that ZIRP world into something that's got a reasonable cost of, you know, borrowing, you know, expense. So I think you know, unique, but I think the scenario where, you know, US 10-year went, you know, sort of up through 6-7 is probably under a different construct. So and it's probably not something people want to think about. So that's why I think we should discuss it.
Look, please join with me in thanking Simon. Look, if we do get debasement, we'll be in the kitchen out of defrying pan and into defire. Look, this last session led perfectly as a segue to our next session, which deals with alternatives, the roles that they might play, and and in the context of the catastrophization we've just discussed, the protection they might offer. It's my pleasure to invite David Hutchison from North to moderate this session. David.
So obviously, I'm not going to talk about any decent content because you don't want that. But I do have three people to join me to actually talk through alternatives, and particularly around thinking about how we can solve the issue that Michael and Jason have spoken to around how do we get more alts in platform land. So I've got three people, as I say. First up, Kieran. Kieran's CIO at Centric. And so obviously, as a licensee, supports both retail and wholesale investors. I've got Alex, who's the PM at Russell, and Alex is going to help us solve some of that alternatives into the retail space shortly on North. And then finally, we've got Stuart Elliott, fan of debasement as well, but he looks after the portfolio design at AMP Investments, so both our funds and managed portfolios. So obviously, we've spoken a bit around the role of alternatives and how it can play usefulness into portfolios.
Yep. Okay. And so a lot of the focus, obviously, from an institutional perspective, has been into alternatives over time. We haven't been able to allocate as much into advised portfolios. But kind of we're starting to get a lot more into that space. Clearly, private credit has kind of been an answer for many around alternatives, but it's a lot broader than private markets as well. And so first question I want to start off is just get a bit of a current state of alternatives in your portfolios. So what are you investing in and why, and what are you looking for them to do within portfolios? Stuart, I might start with you, thanks.
Thanks, David. So we manage the full range of portfolios at AMP because we manage the super fund, managed funds, and also managed accounts. And the role that alternatives play in each of those is really a function of the time frame of the portfolios. So if you have something like a super fund, the investment horizon's 30, 40 years. And so that's where we have our highest allocation to private market assets and alternatives. And these tend to be things like direct infrastructure, that's sort of 4 to 5% allocation, direct property and private equity, they're both sort of 2 to 3%, and then private credit, which gets all the discussion and all the focus is sitting there at 2%. So it's not a huge part of the portfolio that we blended in with other types of credit as well. In the managed funds like the North Professional Series, because investors can come in and out as they wish, we don't hold those very long multi-decade assets. And so we focus there on private credit, again at around 2%. And then in the managed portfolio space, it's a different world and one that you need to think about differently because some of those will be people who are just using a low-cost index option. They're sort of growing their wealth stage, but also you will have some very large, maybe multi-generational money there, and you can really be thinking about how you might want to start putting sort of your longer-term private market assets into those portfolios.
Right. I'll start off in our group. We're quite fortunate in that we have two areas. We have a managed discretionary account as opposed to a managed account. So that is run under retail. And for us, when we look at that retail managed discretionary account, we do run those on platforms. So they're IDPS and public offer super. So we have the traditional issues in there, which is around retail disclosure you need, and it's around the liquidity requirements, especially within public offer super. We went down a different route probably a decade ago, which was we wanted alts in those portfolios. So we constructed alts programs. We constructed a defensive and a growth alts program. They run on a balanced portfolio, so a 60-40 portfolio. They're running at about 15% of that portfolio. And they are within a PDS structure. They're fully liquid at the PDS structure, but there's complexities in constructing those. So that's the one area. We then run a lot of family office, not-for-profit money. That is much more under an OCIO service. A little bit of it is on IDPS, but often it's non-custody. There we would see up to about 40%. And that 40% that we run typically would be across alts, various areas within alts. So maybe it's just worth sort of saying as well, when we look at alts and private assets, alts we typically look at in sort of a private equity, private credit, an opportunistic sleeve, an infrastructure sleeve. Those are the sort of sleeves we look at. However, sometimes we will use private assets within the standard fixed income sleeve as well. So we would run a fund in there where we would have, let's say, JP Morgan or someone running the core for that fund, and then we'd have a satellite in that fund, which might be Schenkman or something like that. So that's really the way we do it. Two different ways of doing it, just depending on the client and obviously the how we have to manage liquidity and disclosure.
Yeah, absolutely. So I think similar to Stuart, we run super diversified funds and SMAs, and I think that evolution that super's had more private credit, private infrastructure, private property, a bit of private equity. Diversified funds have had a bit of private property and infrastructure, and then recently with the SMAs, what we've been working on is building out a private markets SMA that is monthly liquid or PDS. I think there's two angles to this. So for the alternatives, we think of it in two different lenses. So the first is the private exposure, the illiquid exposure. We've gone through that. I think the second is around thinking about what can we use in the portfolio to provide protection for equity/bond downside. So that worry that was being talked about before, where the 10-year bond yield goes to 5.5, equity markets fall. And I think there are a couple of interesting options. I mean, the most important one that we use in both the diversified funds and the super product is actually long volatility managers. So actively going out and finding managers that smartly try and play that long volatility and give you that tail risk. The other one that we're doing quite a bit of work on globally has been cross-asset trends. So sort of your CTA style manager that we think provides quite a nice alternative to using government bonds as a diversifier for those scenarios.
Okay, we started touching on this, but kind of obviously managed accounts find it difficult to get into some of those less liquid kind of products. I know me and plenty of my platform colleagues are working on solving that and looking to kind of bring out either wholesale and or retail kind of solutions. And I know we're not far away from pulling one together. What do you make on that focus on illiquid assets in, I'll start with advised portfolios, but also then flowing through into managed accounts? Is there too much focus on trying to capture that illiquidity premium?
I think there's a lot of focus on private credit right now, especially Australian private credit. I think there is a lot of opportunities globally. More broadly, I think the illiquid exposure makes a lot of sense. And the key thing is, for your end advisor or your end investor that's looking to get exposure to the productive nature of the economy, the listed market is increasingly small compared to the private market. And so being able to get that illiquid exposure, that private equity, secondaries, whatever flavor it has, I think has a lot of benefit. And there's been probably more papers than we needed to write about the illiquidity premium, but from our view, we do think that it does exist. You do get compensated for taking on that illiquidity, and for clients that can do it, I think it's a really clever and good approach.
Go.
Yeah, so to keep the theme going, if you are concerned about debasement or just want good, solid long-term returns, then direct property and direct infrastructure tend to have cash flows that are linked to inflation, so you do get some protection through those. The one that really concerns me is private equity. We're seeing a lot more regulated focus on valuations and timely valuations, and one of the great attractions of private market assets is their volatility laundering characteristics. And if the situation changes and trustees and responsible entities actually feel like they're obliged to mark their private equity holdings to market every time you get a 10% down draft in equities, then suddenly you have an asset that has a correlation of 1 in down markets and 0 in up markets, and this is not the diversifier you were looking for.
Yeah, so broadly, I would agree with what you guys are saying. I think for us, there's nuances though in some of the private assets. So if we're looking at PE, our preference at the moment would be to look instead of at the long dated PE funds, because I think they just haven't performed. They haven't delivered on what we expected. Also, if you want vintage diversification, you're locked up for 20 years plus. But there are ways when you can look at some of the crossovers of accessing some of the late stage privates. And I think, being able to do that, and also in some of the co-invest where you've got later stage, that's a focus of us, which is just a bit more nuanced. But otherwise, 100% agree with you.
If we keep going up the curve into the institutional market, one of the constraints, if you like, is around the performance test. How does that impact on your thinking around what you can bring down from institutional into managed accounts and wholesale investing, given that has such an important constraint, if you like, around how you invest. Alex, do you want to start?
Yeah, so I mean, the performance test takes up a lot of people's time and thinking. I think more broadly though, when we're thinking about bringing those wholesale solutions, it's less the performance test and more the institutional knowledge. So I think that one important point that both guys have made is, there are risks around these assets, and the most important thing is really doing very diligent manager selection. We've been doing that sort of stuff for 60 years. And so I think it's just bringing best of breed. The performance test is kind of an aside, and it's really about bringing the best solutions to market.
Yeah, I would agree. On the performance test in our portfolios, when in the construction of portfolios, the only time that we really take it into account is if we're running trustee-directed portfolios, so they fall under the performance test. It is especially hard in the alts bucket because, as you would know, the way APRA looks at the alts bucket and the benchmarks that they use for those are not aligned necessarily with the benchmarks of actual alts. However, for the other portfolios, we much prefer to take exactly what you said, which is getting to a point where we can take the institutional know-how onto select managers, the implementation, the operational due diligence, valuations, those sorts of things. Those are the sorts of things we want to bring down, not necessarily the performance test.
I was hoping I could go an hour of my day without thinking about the performance test. This again is a negative for private equity because you're benchmarked to listed equities. That's great for you in the short times when the equity market's going down because your private equity perhaps holds up its value. But after that turning point, you might end up 20, 25% behind because you're still getting down marks coming through for your private equity as the listed market is off to the races. More generally, if we sort of think about liquid alternatives, we want to make sure that however you construct your liquid alternatives portfolio, it's able to do a good job relative to the performance tests alternatives benchmark, which is sort of typically 50-50 equities bonds.
One of the other issues we face a lot in the retail space is costs and fees. How do you think about all of that into the portfolio? I mean, normally the true investment house says, well, after fees is what matters, but we know there's a little bit of intermediary influence in that cost selection. So how does that impact on your thinking about where you end up allocating and what you're thinking about alts?
So in everything that you do, it's an economic decision. It's a payoff. So you have effectively a fee budget and an active risk budget, and then you just work out what is the best way to spend that over your entire portfolio, given the objectives that you're targeting.
I think from our side, when we're looking at the costs, when we're looking at the retail portfolios, you need to also understand the cost of the feeder funds from an RG97 point of view. That's super critical for advisors and clients. And you could say, well, look, we've got phenomenal performance and my fees are 5% because the performance fees have been so high. That's actually incredibly difficult for advisors to deal with and for clients. So we are very focused on that and how do we manage it? Now, there's not a lot you can necessarily do with it, but it is a key function for us. When it comes to our portfolios that are run for large families, not-for-profits, there we have an extremely strong focus. Our focus on there is actually running co-investment programs. So and there's a couple of people, Stepstone do it, we use Grosvenor. Those co-investment programs, pretty good. The main reason you run them is for price, but you'll run them as well because you get diversification at the GP or the sponsor level. You'll get diversification over various vintages. If you're in PE, private credit, and that's maybe a little bit different. But in there, that's just about cost. And those, we want to be at the same program level as a CalPERS or a Texas Teachers or Singapore Investment Corp. That's where we want to sit. And typically those programs will give you the best managers, the top quartile managers, and you'll run that at about 1 in 10 compared to if you're running those managers, and that's including a feeder. If you're running those same managers with a feeder, you're probably well over 3 in 20. So that focus is there, but you can't do it in the retail world. It's just not, the liquidity is not there. There's too big a liquidity mismatch.
Yeah, I think both guys have covered most of it. So for us, it's really about modeling out after fee returns. And I think also really being clear when you are modeling out, especially private equity where you have the 2 in 20 or 1 in 10, whatever it is, with the carried interest, really modeling out what those fees will look like over the lifetime of your investment and being really crystal clear, both for our institutional funds and also for the retail funds that we're looking at, to make sure that we're very upfront and we're very aware of what the fee structures will look like under different scenarios.
If we keep focus onto the retail space, we've spoken around institutions and endowments liking, 30, 40% allocations into into this kind of space. Clearly, though, the super trustees, particularly given some heightened investment governance focus at the moment, is not quite willing to go to that kind of level. So, a lot of talk around holding limits and where do you end up? What's the right allocation in a retail portfolio? And given the liquidity mismatch, it's a really different beast to be able to run that as a retail managed account. So where do we start thinking about in terms of allocations in those managed accounts?
Okay, we're running a managed discretionary account, so it's a little bit easier than running a managed account. But our allocations, really, when we get into there, they're probably about half of what we'd see in that the not-for-profit family office sort of space. And we've had to tailor build them. So we've had to build them into funds that a number of the guys, whether it's an EQT or it's a trustee of a BT or whatever it is, that they will actually approve those. It's important to understand what their requirements are as well. What are their legislative requirements? What are they trying to solve for? Whether, it's paying out a death benefit, whether it's hardship, etc. So we have found that we can put private assets within certain fund structures, because the fund structure, especially if you've got hundreds and hundreds of millions in there. So our hedge fund program would run with about 800 million in there. Some of the other ones, fixed income, would run with several hundred million. So you can put private assets in there. So if you look, we're fortunate that if you look at our retail clients, they would probably have access to alts and private assets that are stretching above sort of 15 to 20%.
Okay, so I think alternatives broadly for retail, we have kind of hedge funds, long volatility. You want to have pretty small because it's a tail risk, right? It's a tail risk hedger. Hedge funds, kind of that 5% range. And then for privates, we've been doing quite a bit of modeling on this. And I think around that 10 to 15% is probably the max. And that's a nice trade-off of you are giving up some liquidity for clients and you don't know what's going to come around the corner. But you do get the benefit of, if you imagine the efficient frontier, you move up into the left. And so that 10 to 15 gives you enough of that boost without taking on, excessive liquid exposure.
Okay, and if we start talking a bit more to the future, we've spoken a lot about the structure and some of the constraints and how they're starting to be solved and how you think about putting them into portfolios. But what's going to be different in 5 or 10 years' time around the alternative space? Because it's clearly going to evolve a little bit as we see rapid enhancements. Yep.
Yeah, I think that the alternatives allocation in managed accounts will look a lot like Alex described it, I think, building on that. So I 100% agree on having a long volatility strategy and trend following, or there's some sort of cheap, systematic alpha strategy there that can perform well in up and down markets, but also sort of continuing the theme from before, an allocation to gold, whether or not that's passive or actively managed, and also, of course, Bitcoin, because we are thinking beyond private markets and new ideas here. We like both of those assets. Gold, you can look at who's buying it right now. It's mainly the central banks, and as well as reducing their sanctions risk and reducing their US dollar exposure, they're also shortening their interest rate duration and improving the inflation hedging characteristics of their portfolios, which probably speaks quite loudly as to where they think the inflation trajectory is going. And then other good things about gold is it's a dominant player in a duopoly and it never misses on earnings. So these are all good characteristics. But we also like the other member of that duopoly, which is Bitcoin as an emerging store of value asset.
Well, I think from our side, we would see the privates alt space being very, very different. From a perspective of, if you think about the secondaries market in equities today, it's 100 around the world, 127, 130 trillion. The secondaries market that we see today in private assets, whether it's PE, private credit, etc., that market is nascent. And a lot of it started off because they were hard to sell assets that were non-performing, etc. I think the biggest change we will see is those markets coming of age and being able to access them in ways that are going to be much broader and simpler to access. So that would be my expectation, is that we would actually be able to use them in retail type portfolios. There will be better access. There's some things that have to be solved for that. Some of these have limits on the type of clients that can go in. That is liquidity potential mismatch. We've seen some people list private equity and things like that, and you end up with a mismatch and you end up with a discount, trading at a discount to NAV. So some of the things have to be solved, but I would expect that's what we would see. And there's such a volume of these assets and they're growing at such a volume, it makes sense that that happens.
I think they're on the private credit side, I think Australian standards will move more to American and global standards where they've been doing this for 30 years. So I think that's a really good thing for the end investor. I think the access to private markets will just keep expanding. I think there are still roles for those listed, and I think the worry about debasement and treasuries, etc. I think that allocation will increase across managed accounts. One thing that makes me nervous, I don't know, has anyone seen the lines at ABC Bullion in Martin Place? I just walked past before, like 70-meter lines. Not sure what that means for the near term, but I think that general trend will continue, and then just more access to private markets will come through.
Very good. I might open to the floor. Are there any burning questions? I know that alts is clearly a lot of focus, but
oh, sorry, the question was, how do you define a defensive alt versus a growth alt? Is it to do with chance of loss, max drawdown? Is it to do with, is it a debt security or an equity exposure? Because, you could say private debt since it's the flavor of the month, but you could have venture debt versus securitized property debt versus thing. Yeah, so just how you guys sort of break it out. So I think that's what I'm trying to do in our portfolios is there's alts, but they live in different places with different attributes.
I'm happy to go first if you want me to go first. I think from our perspective, we do run in retail both the defensive and growth alts. You've got the definitions or the accepted definitions from APRA and that, what your benchmarks in those are. Typically, though, for us, it's why are we using these alts and what are they trying to do? For us, when we define the mandate for those, and your mandate flows back into the capital market assumptions that flow back into your strategic asset allocation and then impact your tactical asset allocation. Typically, what we would see is we would expect lower volatility, so dampened volatility. So we would expect a return on our growth odds somewhere around about the 7% mark, maybe 8% mark, but with a vol about half of the MSCI equity. Whereas and then other characteristics as well, but the vol, and these are publicly available, so you can have a look at them. The vol, we would expect on the defensive alts, more correlation benefits in there as well when you have big dislocations. We would probably expect about 4 to 5% returns there, and vol that's sitting at 2.5%.
Other questions? I've got a question about the sort of manager selection process for any one of the three of you. In listed markets, we're seeing the contest between passive strategies and or systematic strategies and active management. That doesn't seem obviously the case in the sort of alts that we're talking about here. So to talk a little about the sort of manager selection process and how you manage what is the last refuge of the active managers.
For us, we're going to be using specialized teams to select the managers. So we have specialists for equities and fixed income, alternatives, private markets in each of those. So we have someone who knows the full range of managers, knows their histories. And so if you're looking at sort of private credit assets or something, you don't want some people who just come out of a bank or a credit fund. You actually want to see people who've got extensive experience doing workouts when loans go bad, because it's possible that you might need that expertise soon.
I would just add a couple of things, and not so much on the selection, because we use absolutely specialist teams to do that, and we would actually use external teams as well. But probably some of the things that I would look out for there is, one, the dispersion between the top and the bottom managers is huge, and especially in volatile times. So if you look through the GFC, you look through the 2000, the dispersion actually blew out on between the top quartile and bottom quartile. The other thing that is, especially in PE, quite difficult to get one's head around is the use of IRR. it is extremely susceptible to being manipulated. It's not the same depending on the length, whether they're using some sort of call structure or something to mitigate their call structure, a line of credit or something like that. So we tend to prefer looking at sort of the multiple on, so the MOIC, those sort of things, which sort of give you a much better sense of how you compare those managers. I would just watch out on IRR. It's not a great, it's very susceptible to being manipulated.
I think the manager selection piece is kind of, specialist teams, etc. I think the other bit that is really important is looking at legal reviews and making sure that you've got a legal team. So we have legal, both internal and external, that would do reviews of any fund document, offer document, to make sure that everything is above board and in line with what we would expect. But I think to Kieran's point about the variability, and I've done a shameless plug for Russell, so I'll give a plug to JP Morgan, who do some great work. Their guide to alternatives has a really nice chart on the dispersion of returns for private assets versus public. Private equity dispersion is bigger than listed equity. Private credit is bigger than listed credit. So this is really a really important part of the process.
Yeah. I'd also add, make sure you do your due diligence on the RE, not just the portfolio management team.
Yeah, and ops due diligence comes in hugely in these things as well. Operations can blow these guys up. And I think the trustees will start getting more into that as well, if the ops due diligence, not just the due diligence on the manager.
Yeah, the regulator's hot to trot on all of us for that. I'll give
Yeah.
you that tip.
All right.
So look, I think that rounds things out. No burning questions to finish off.
No.
Look, clearly a interesting space to think a lot more about alts. A challenge to managed accounts. We've not been there deeply yet, but I think me and most of my platform colleagues are doing the heavy lifting to try and make sure that comes together. Asset managers obviously bringing more and more product to help us out as well. So yeah, deep thought. But please join me in thanking Kieran, Alex, and Stuart.
Thank you so much.
Thank you very much, David. And now our final session before we listen to ASIC is a session focused on what is symptomatic of the emerging product differentiation, product refinement within this market. It's my pleasure to invite Daniel Chu, a new alumni at BetaShares, to talk about fixed income.
All right, hi everyone. My name is Daniel Chu. I'm the newest multi-asset portfolio manager at BetaShares. I think Vinny Wadera wanted one of the ETF PMs. He's up at the back there to present this. But we thought managed accounts were really focused on client solutions. Your end clients want to define outcome, and we want to help improve the probability of reaching that. So today I'll be talking about managed accounts and how we can improve predictable income. So let's rewind a little bit. So it's March 2020. There's chaos on the streets, literally. And your global CIO calls you up from New York and asks you line by line, what's in your portfolio? You start with equities, that's the most volatile. Then you move to alternatives, we just talked about that. And then we start talking about Aussie fixed interest. And really what you want from Aussie fixed interest is something that's more predictable in terms of outcomes. So I'm going to be walking through one of our latest innovations. And again, we're innovating for the end client. So let's move on. So predictable income, and I'll be talking about 3 ETFs, but more importantly, talking about the managed accounts and how to use these ETFs. So just as a disclaimer, this is not for retail, but for advisors and financial professionals only. It's the first time I've actually read that out, but I have to at BetaShares. But really, what I wanted to talk about today is how to look at defined income as a whole. Before I dive deeper into this, as Toby just mentioned, I just left Russell Investments. The gentleman who's sitting here, Alex Cruisley, I used to work 1 meter away from him for 13 years. And we always used to talk about dynamic asset allocation. Markets go up, markets go down. Donald Trump sends out a tweet and suddenly equity markets are down 3 or 4%. And we were using cycle, valuation, momentum, BetaShares pretty similar as well, to look at investments. But wouldn't it be nice for maybe 20 or 30% of your portfolio, the fixed income part of your portfolio, to be more predictable. So you could spend more time on equities. Of course, you would have to assess credit risks from time to time, but wouldn't it be nice to have a more predictable outcome when it comes to income? So enter 28BB, 29BB, so on and so forth. Sounds a little bit like Star Wars characters or robots, but what these are really defined maturity ETFs. In order to get to the managed account part, which all of you are more interested in for end clients, we have to actually talk about what these ETFs are. And I really like to unpack the basket of corporate bonds that these ETFs hold. So let's take 2030BB. 2030BB has a target date of 31st of May, 2030. And in its DNA or methodology, we take the 12-month window before that, and we add all the different corporate bonds into a basket of ETFs. Why is this important? It has a defined maturity. You're going to be potentially buying these corporate bonds and holding them to maturity. And you're going to see predictable outcomes, which we're going to show later in the session. And so here, you can see on the right-hand side, intentionally in very faint text, all the corporate bonds that this 30BB ETF holds, from ANZ, which matures in June 2029, all the way down to Woolies at the bottom right there. And so we hold an equal weighted number of corporate bonds, and it's currently yielding about 4.3%. That is about 1% higher than a 5-year term deposit. And if our ETF portfolio managers were here, this is definitely a target market in terms of term deposits and how we can substitute more predictable income. And so we collect this basket of corporate bonds, again, very transparent, very easy to see what you're holding in terms of all the different corporate bonds that are here. So let's talk about one of the key attributes, very predictable monthly income. When we collect all of these 30 corporate bonds, we put them into a basket at the beginning of the launch of the ETF, and we can calculate a reasonable yield that this basket of bonds is likely to generate. So again, use 4% or 4.3% as an example, and we can divide monthly income every single month. So if you go onto our website, and I'm going to show you the calculator soon, you could see that this particular ETF, if you had $1 million invested in it, would generate about $3,500 of monthly income, month in, month out, month in, month out. So when your global CIO does call you up, you can say what the predictable outcomes are. The other part of this is that if you look at this, you put an initial investment, you get the monthly income, and it's very likely, based on the number of defaults or lack of defaults, that you will get a similar amount of principal back at the end of it. And for those, there's a pop quiz. Out of the last 25 years, how many senior debt Aussie dollar denominated corporate bonds have defaulted? 0. Someone said 0. So 0. Of course, history is not an indicator for future performance, but that can tell you that based on an average A-rated basket of corporate bonds, it's a pretty low likelihood. The next key attribute, again, I'm going to get to the managed account side of things soon, but other key attribute that you should understand before we even talk about the solution itself is that it's liquid. Unlike term deposits, unlike annuities, you can't just go onto the ASX and sell it back to the market. But with these particular corporate bonds, you can sell them back to the market. So they are liquid. So if your clients are looking to rebalance, looking to invest in a house or what have you, then you can easily sell them. And so they are liquid. So again, predictable, but also liquid. Predictable, liquid. Those are the main things to focus on. To prove this, and I think someone talked about COVID-19, talked about the biggest sell-off in bonds in 2022. If you look at the chart that you see here, you can see that corporate bonds sold off by about 15% in that period of time. But if you were to hold this particular basket of corporate bonds that mature in 2023, you would see the outcome in orange. And this, of course, is a back test. It's a simulation, but you would see a predictable outcome. The starting yield of these corporate bonds was 3.2%, and the ending outcome was 3.2% or thereabouts. And so what this chart shows is that you didn't really need to worry too much about the credit risk. And the key reason for this is you're holding them to maturity. How many of us receive calls from our clients in 2022 asking, what has happened to my bonds? I thought these were safe. what happened to them? And we had to explain to them, if you hold them to maturity and there's no defaults, you're going to get back that return. But with a defined maturity basket of corporate bonds, you can really see that. The distinction between that, and this is maybe testing my explanation here, but the distinction between that and a broad basket of bonds is that there's always new bonds coming in, and so they're accumulating losses in an interest rate hiking environment. Whereas with these defined maturity bonds, you hold them to maturity, and effectively you got the choice to roll them. So it gives you more control. So hopefully that makes all sense. Again, very quick 10-minute update on what these actually are, and then we'll start talking about the managed accounts and how the end clients really benefit from these. As I mentioned, we have a calculator. With technology nowadays, our portfolio managers do everything. They not only run the funds, they even build calculators. But here you can see a calculator that's attached to the 2030 Defined Bond Income ETF webpage here. And you can chuck in an investment amount, say $100,000, and it will show you how much the monthly income is and what the projected yield is. And that's important, 4.3% net of fees when a 5-year term deposit is generating 3.3% and doesn't have any liquidity as well. So really, as I will talk about in the managed account solutions, these are liquid and predictable as well. The other thing you can do is hit the tab and go to target. And if you wanted a targeted amount of income, say $4,000, it would tell you that you would have to have $1.1 million in this sort of solution. So let's race into part 2. And as promised, talk more about the managed accounts. I can see many asset allocators here. I can see a lot of advisors here who use managed accounts. And really, again, it's about efficiencies. So let's start with case study number 1. This is a managed account with Aussie equities, global equities, listed infra, etc. And let's say, for example, you wanted more predictable outcomes in Aussie fixed interest. You could take out an Aussie fixed interest exposure and put them into a ladder. And that's a key word. We're going to see more innovation here in fixed income, a ladder set of ETFs or predictable maturities. And so when 28BB rolls around, it has a yield of 4%. When 29BB has a yield of 4.1 and 4.2 and so forth. When they mature, you have the choice to roll them or reinvest them back into equities. Again, more control, more predictability. And these are innovations that we've seen in the US for quite a number of years. In fact, bond ladders are some of the most fastest growing fixed income solutions in the US right now. And as you can expect, beta shares, out of all the defined outcome solutions in equities, fixed income, multi-asset, have chosen to go for fixed income defined maturity bonds. And so again, I think it's something to watch, something to note in terms of helping improve the probability of success. So the next case study I'm going to show is a targeted exposure. Well, many asset allocators here, and I won't put a survey in terms of show of hands, but imagine Trump runs for 2028. Just imagine that, Bannon's already talking about that. And so you could have a more targeted way of allocating fixed interest. Say, for example, you thought there was even a slight chance that Trump ran for VP or president in 2028. It'd be pretty crazy. But imagine that, and you wanted to hedge against that. You could set your maturity at 2028 to ensure that the chaos that is going to be the US presidential election in 2028, when credit spreads potentially increase, when inflation expectations increase, you could do something about that in 2028 and effectively roll your bonds and have the choice. You're not beholden to an index or methodology. You have more control over your fixed interest. So again, this is part of the reason why we're saying predictability in terms of outcomes, liquidity, and more control. So this is how you can get more targeted exposure. This is probably more on the DAA side of things, but essentially it's a play on what bond futures have been doing, or CDX, or iTrax, or any of those. You can use these particular solutions to enhance the probability of more predictable outcomes. And that's the key part of that. Retirement and bucketing solutions. I think all of us have built bucketing solutions. We all know very large consultants right now that really are at the forefront of bucketing solutions. And let's talk about this scenario here. So you've got the long-term bucket, on the left-hand side, and you got the medium-term bucket and the short-term bucket. You can adapt and align your portfolio in terms of credit maturity based on the investment time horizon of your particular bucket. So if your long-term pool of assets is targeting 7 years, why not use a longer time horizon in terms of the maturity of your bond ETFs? And then when you look at medium term, which is a diversified pool of equities and fixed interests, you could blend something that matures in 29 or 2030. But I think the one that's more interesting is a shorter term pool. This tends to be a liquidity pool for your retirees who want to spend their money from day to day. And here you would look at something that has a shorter time frame. So normally that's 0 to 3 years. Well, we got something that matures in 2.5 years in 2028. And we've intentionally put in a 30% allocation. So cash would be something that helps you over 1 year. Short-term credit would be something that helps you over 2 years. And then the 2.5 year maturity corporate bonds would help you over 3 years. Again, being more adaptable, aligning the maturities in your portfolios. We think that's going to be something that's very unique for the Australian market. But again, it's been a wholesale use case in the US for quite a while. And then number 4, if Cam Gleeson was here, he's the head investment strategist at BetaShares, who would talk about holding these particular solutions outside of SMA. That's why he hasn't been invited to this. We're talking more about managed accounts. But again, it's more of a solution when it comes to if your clients needed the money in 5 years or 3 years, and you knew that they needed $50,000 in this example, take it out of the SMA, put it into something that would have defined outcomes, higher probability of compared to a normal corporate bond, and be able to reap the income of about 4.3% net of fees. So again, this is one of the most popular use cases that we've been talking to clients about. But again, it's to improve retirement outcomes. This isn't about just the ETF. It's more about improving probability of success for all of your clients. Then finally, this is case study number 5. About half this room, I would guess, would have direct shares in their portfolios. There seems to be a love-hate. Some people love them, some people hate them. I've actually ran managed accounts with both of them. But if you wanted more transparency into a particular bond, you could invest in individual bonds, but that would be a bit of an operational nightmare. Or you can invest in these ETFs here, we would hold the corporate bonds from start to finish. And so they don't change. We don't roll them. We don't put in new bonds. It's the same bonds that are there on the day one all the way to maturity. And so if you wanted to build a report, if you wanted to build a portal, you would have the same ANZ, CBA, Woolies, what have you. And so that would be a very transparent way to look at a total portfolio, not only direct shares, but also bonds as well. So that's why we like these ETFs, in particular when it comes to transparency. Before I open up to questions, I'm sure there are quite a few, given that it's quite an innovative space. I just wanted to talk about the breadth of the fixed income solutions at BetaShares. And so you can see that we're running about 20 or so different solutions here. And really, we're really focused on the defined income side of things. I think you're going to see a longer list of solutions when it comes to defined outcomes, not only in equities, but fixed income for managed accounts. So if you have feedback for us, we'd love to work with your clients to build out the right solutions for you, once again, to improve the probability of success. And so that's really what I have for you. If you want more information, reach out to Vinny or James here, who's come here. Actually, I know a lot of people here. Yeah, we'd love to talk to you about how we can help your clients.
Questions for Daniel. I've sat in a few product development committees in my time, and one of the things you do is you have to, once you've figured out the product characteristics and this and that, you sit down in the naming committee and you go, okay, what are we going to call this? We're going to call this, Charger, Ranger, whatever. I've never sat in a committee like that where somebody said, hey, let's call them after brow sizes.
It's BetaShares bonds. I intentionally found out from from our PMs today that these are BetaShares bonds.
All right.
Yes.
There are questions about the structure and for this or other considerations about the about this. Yeah. Oh.
Hi, just a little on the technical side. How do you deal with new flows into the fund over time? You're buying little pieces of all of these bonds at regular intervals as money comes in, or?
Yes. So let's go back. Let's go back to the corporate bond slide. So this one here. So when we start the portfolio, we start with an equal weighted number of bonds. This could be 50, it could be 20, it could be 40, depending on the issuance of that particular year. We will drift these weights away from equal weighted based on the opportunity set when it comes to liquidity and pricing as well. So there's a bit of active management in this, but it is at the heart of it a very hold to maturity type portfolio. And part of the key reason for this is we're trying to minimize turnover. And so we're trying to be very smart. There's going to be redemptions and there's going to be applications on any given day. So we're trying to be smart in the way we read the flows of the market as well as liquidity as well. So right now, one of these bonds is 4.5% and another one is 2.5%, but it doesn't deviate too far from 3%.
So I guess that gives rise to another question, which is as the credit characteristics of the underlying instruments kind of drifts apart, if somebody says, look, Bendigo's gone from whatever they are, double B to double B minus or something, how are you managing that kind of weighted average?
Yeah. So I asked the same question to our PM. So that's the beautiful part about being a multi-asset PM. I get to interrogate my own team. So really what happens there, say, for example, let's go more extreme. What happens if there's a default? What are we going to actually do? So it'll be a case-by-case example. We will essentially most likely hold it and try and recover the capital. So it really is, the objective is to hold to maturity and beyond really, if they're in the case of a default. But as I mentioned before, there has been 0 out of 25 years in terms of defaults, and these are A-rated companies. But of course, there's a probability of default.
Right. Any other questions for Daniel? Look, please join with me in thanking
Thank you very
Daniel
much. I appreciate it. Thanks.
Now, before I introduce Alan Kirkland, our next and final speaker, somebody found a ring in the ladies' Matt. No, anyway, there was a ring in the ladies' bathrooms. If that happens to be yours, I've got it. Otherwise, okay. All right. Okay. Let's there were a lot of slides. Okay. Right. Let's go back. Okay. It's now my pleasure to introduce Alan Kirkland. Alan is a commissioner with ASIC and has been in that role for just coming up to 2 years. Previously was CEO at Choice for more than 11 years and has been the executive director of the Australian Law Reform Commission. Alan's intimately involved in this, in our part of the retail, of the financial services market. And as many of you will have seen in ASIC's corporate plan for 2025-26, they announced that they would be undertaking a review of the of those who recommend or offer managed accounts. I thought it very appropriate to invite Commissioner Kirkland to speak to us today about their view of managed accounts and what that review might be. So he'll speak for a few minutes, and then he and I'll engage in a bit of Q&A, and then we will leave time at the end for questions from the floor. So thanks very much. Please welcome Commissioner Kirkland.
Thanks, Toby. Thanks, everyone. It's great to be here. I'm conscious I'm at the end of what's been a long and busy morning stretching into afternoon, so I'll try and be brief. I'd like to begin by acknowledging the traditional owners, the Gadigal people of the Eora Nation, and by paying my respect to their ongoing connection to and custodianship of the lands on which we're meeting, and I extend that respect to any Aboriginal or Torres Strait Islander people here today. Today, I want to speak briefly about consumer outcomes because at ASIC, the financial wellbeing of Australians is core to what we do, and we pursue that in a range of ways. We license and monitor financial services to ensure integrity and professional standards. We hold companies and businesses to account, ensuring that they operate honestly and fairly. And we publish educational resources and information through our Money Smart website to help Australians to make decisions that can advance their financial wellbeing. Toby mentioned our corporate plan recently released. Two of the 5 strategic pillars in that corporate plan are directed at the financial wellbeing of Australians. One that's focused on improving outcomes for consumers generally, and one that's focused on supporting better outcomes for retirees. And obviously both of those relate directly to your role in the system, and they provide the context for what I'd like to speak about today. I'd like to start by making a general point, and that is that responsibility for good consumer outcomes does not fall solely with ASIC. It's the responsibility of everybody who operates within the financial system. So for licensees, generally, that means ensuring that you continue to fulfil your obligation to provide efficient, honest and fair financial services. For advisors, it means acting in the best interests of your clients, providing appropriate advice and prioritising their interests over yours. For fund operators, it means fulfilling your obligations as a responsible entity and licensee, including acting in the best interests of scheme members and providing efficient, honest and fair financial services. For platform operators, that means continuing to perform your obligations honestly and with reasonable care and diligence. And for ASIC, it means ensuring compliance through our supervisory and surveillance work and addressing misconduct where we see it. You'll all be familiar with your obligations under the Corps Act, so I won't rehash them here, but there is one obligation that carries particular importance for people involved in the provision of managed accounts, and that's in relation to the management of conflicts of interest. Recently, we consulted on updates to Regulatory Guide 181 on the management of conflicts of interest for AFS licensees. That guide has not been updated since 2004, and so we needed to update it to reflect changes in the law and policy. And as RG 181 in its current and proposed revised form makes clear, a number of provisions of the Corps Act raise obligations in relation to conflicts depending on an individual or entity's role in the provision of financial services. But one of the most important is the core obligation in section 912A1AA to have adequate arrangements for the management of conflicts of interest that may arise wholly or partially in relation to the provision of financial services by the licensee or their representative. Now, that obligation is very broadly framed, and it's articulated in the law as a key obligation of licensees. So the intent of Parliament is very clear. And we expect licensees under that obligation to engage deeply and on a regular basis to understand where conflicts may arise and ensure that their arrangements for addressing those conflicts are adequate. The proposed changes to RG 181 have been informed by observations from our surveillance and enforcement work in recent years, and they aim to better articulate how the law applies, including its scope and operation with other related obligations, the types of conflicts that you need to identify and manage in order to meet your obligations, the need to have robust and tailored arrangements that are adequate to manage those conflicts, and how you can effectively manage conflicts. And I want to say we welcome the engagement of many people in this room in that consultation process, and we aim to publish the final updated guidance by the end of the year. Moving on to managed accounts specifically, it's clear that managed accounts are playing an ever-increasing role in Australia's investment landscape. So based on IMAP data, funds under management have increased by an average of 24% each year since 2019. Of course, much of that growth has been in separately managed accounts, which are the largest category of the overall managed accounts sector, with the other main category for retail clients being managed discretionary accounts. And I mentioned the growth rates. When regulators see shifts like that in market composition and dynamics, we are naturally interested. We are interested in what's driving those changes, what the impacts are, how different incentives might influence those changes, and most importantly, what they mean for consumers. And that's why our corporate plan for the next year highlights managed accounts as an area of focus. It has been a number of years since ASIC took a detailed look at this area, and given the growth and potential risks we are seeing, we consider a review is both warranted and timely. Our focus will be on licensees and advisors who recommend or offer managed accounts to retail clients. We'll examine how licensees are managing compliance with their general obligations, which are at their core require industry participants to act efficiently, honestly, and fairly. We'll examine how financial advisors, when they recommend managed accounts, comply with their obligations to act in the best interests of their clients and provide appropriate advice. And we'll be examining what conflicts of interest may be present and how these conflicts are addressed by advisors and licensees. Managed accounts can be very attractive for licensees at all parts of the product manufacturing and distribution value chain. So we'll be looking at what conflicts may arise, what challenges they may present, and how they're being managed. Planning and scoping for that surveillance work is currently underway. And some of you have been involved in that, and I thank you for your involvement to date. Turning now from our surveillance work to our enforcement work. At ASIC, of course, addressing misconduct and holding wrongdoers to account is a major part of our work. This year, we've banned 16 financial advisors and 40 responsible managers, brokers, or investment managers for non-compliance with their obligations. We recognise that the overall majority of financial services are doing the right things by their clients, but we also recognise, like you, that the behaviour of a small number of bad actors can cause significant harm to consumers and threaten the reputation of an entire industry. And while we can never eliminate all bad actors, we need to work together to minimise the impact of misconduct, and we all have a role to play in that. Licensees, it's your responsibility to ensure that advisors are acting in the best interests of clients and that you have adequate monitoring and supervision arrangements to detect concerning conduct. Advisors, you're in a unique position to recognise where somebody has been the victim of poor advice from somebody else. Individually and in cooperation with your peers, you must uphold and promote the ethical standards of the profession and hold each other accountable for the protection of the public interest. Where you detect concerning conduct, we encourage you to report it to ASIC. At ASIC, we continue to crack down on misconduct because we are all too aware of the significant harm that it can cause. Just look at the devastating fallout from the Shield and First Guardian failures, where best interest duties and conflict of interest obligations appear to have been blatantly disregarded. While these two matters, and calling them two matters grossly undersimplifies the complexity of what we're dealing with, while they've dominated the headlines, they're not the only instances where industry professionals appear to be playing fast and loose with people's life savings. We've currently got active investigations into multiple high-risk super switching matters, each involving multiple third parties and associates. In the case of Shield and First Guardian alone, we've got more than 40 staff involved in those matters, making it one of our largest enforcement projects in many years. We're scrutinising as part of that every part of the value chain. So that includes the lead generators, the financial advisors, the advice licensees, the superannuation trustees that hosted the funds on their platforms, those involved in rating the funds, and the auditors and operators of the managed investment schemes themselves. So far, we've been in court more than 45 times. We have issued stop orders to prevent ongoing harm, frozen assets, made applications to courts for the appointment of receivers and liquidators. We've obtained travel restraints, cancelled financial services licenses, and banned financial advisors, and you should expect to see more of that. As you're likely aware, there's recently been some positive news for some investors. Late last month, we commenced proceedings against Macquarie in the Federal Court following admissions that it did not act efficiently, honestly and fairly by failing to place Shield on a watch list for heightened monitoring. Macquarie also importantly committed to repaying investors 100% of the net cash they invested in Shield through Macquarie's wrap platform. This decision returns the 3,000 affected members to the position they were in before their retirement savings were eroded. ASIC has also commenced civil penalty proceedings in the Federal Court against Equity Trustees Superannuation Limited, alleging failures in due diligence concerning Shield. And last week, we sought to amend those proceedings to seek compensation for the 3,000 investors who invested in Shield through Equity Trustees. However, our work is far from done. It has been and continues to be one of the most complex and resource-intensive investigations in ASIC's history. We're fully invested in combating the misconduct behind high-risk super switching, but it requires a whole-of-system response. While we can never eliminate all bad actors, by working together, we can minimise the impact of misconduct and ensure better outcomes for more Australians. And while that work on high-risk super switching is a major priority, it's not our only area of work for relevance to people in this room. We've got a range of investigations and enforcement actions underway in relation to conduct that we consider to have involved serious breaches of the law, resulting in significant harm to consumers. And in that context, I want to say, at events like this, I'm often asked what people can do to avoid being on the other end of one of those actions. And if that's a question on your mind, I'd go back to the comments I made at the start. Everybody in the system has a role in promoting good consumer outcomes. And while, as I've said, there are a range of detailed legal obligations that articulate what that means in practice, when you strip it back to basics, promoting good consumer outcomes involves a few basic things: understanding your role in the system, understanding the risks that come with that, and most importantly, taking a close and ongoing interest in what happens to the consumers who engage with your services or products directly or indirectly. Because when you fail to do those things, and that results in significant harm to consumers, we're much more likely to come knocking. Thanks for the opportunity to make a few opening remarks. I'm now happy to take some questions. Toby?
Thank you very much, Alan, and thank you for taking the time to make yourself available like this. So I've got a few prepared questions, but I'm keen to leave enough time for those in the audience. And the clock, by the way, is wrong. The fact that you referred a couple of times to efficiently, honestly, fairly, I think is particularly relevant to the managed account structure. I've got a quick observation, which is that compared to the counterfactual, which is advisor-developed portfolios, I can say that in this room, we're amongst friends, much more efficient, more likely to be honest, and certainly more likely to be fair amongst all of the clients, which of course is one of the code of ethics obligations. But to the project that you referred to, the plan says there are three things we ASIC are going to be focused on: corporate governance, management of conflicts, which you referred to, and we'll touch more on, and then outcomes for consumers. Let's talk about the governance frameworks. What do you expect to see in a governance framework for various parties in the chain?
Yeah, there is no template answer to that, because it's very much dependent, as I think I've sort of said in the opening remarks, on the nature of your operations and products and services. And so, I mean, if you just take the example of an advice licensee, you'd expect those arrangements to be different depending on whether the people providing advice under your license are employed advisors or operating as authorised representatives, or a mixture of the two. You'd expect them to be different depending on the sort of managed account offer that you're providing, whether that's an off-the-shelf offer or an in-house proposition. And the same observations apply to to the range of obligations. So those considerations around your model are relevant to the advice-related obligations. So ensuring that people providing advice under your license are providing advice in best interest of their clients, that the advice is appropriate and they're prioritising client interests over their own. but they also go to what efficiently, honestly, fairly means, and some of those other obligations, like the obligation to manage around having appropriate approach to risk management. So I say that in the context where I know there are lots of firms that provide toolkits and templates that are intended to help you comply with your AFSL obligations, and they can be helpful, but ultimately there's no guarantee that they will satisfy us that you're complying with those obligations, because it is very much a matter of you, based on your role in the system, applying independent thought to the particular nature of your operations, the risks and considerations that are thrown up by your role, and then what that means for your license obligations.
Yeah. Okay. Well, let's move on to the conflict of interest. I mean, you mentioned that ASIC issued a draft RG 181, the management of conflict of interest, with a month's a consultation period. I did think it was, I was surprised how little coverage it got for a start, and I also thought it might have had a longer consultation period. We put in a consultation, submission, but I thought more might have been done to sort of bring it to sort of public awareness, because it is just a fundamental piece of regulation.
Yeah, I'm really happy to take that on board, because I think we thought it might have got a bit more attention as well. Certainly happy to take, I mean, for future projects, the timeframe comment on board, because we are, I mean, just as we're dealing with like a huge volume of regulatory guidance that we put out, and some of it is aged. I mentioned that one hasn't been updated since 2004. So we're constantly trying to work out how do we prioritise those for updates, and then we're also conscious then of the burden on industry groups in responding to those consultations. So getting the timing right and the working out which ones to go out on and in what sequence is really important for us.
So thinking specifically about the managed account area, what are the conflicts that in your mind are going to be, sort of front and centre when you approach this project?
Oh, look, I think we're going into this project with a really open mind. As I said, it's in a context where we haven't had a close look at what's happening in managed accounts specifically for some time. So as a starting point, we really want to understand, I guess, what's the state of play? Like, what are some of the different propositions in the market? How do they differ? I think we want to understand, to the extent that there should be efficiencies from offering managed accounts as opposed to advising on individual client portfolios, how are those efficiencies being realised, and who is capturing the value from those efficiencies? We want to understand the relationships between the different players, so advisors, licensees, product issuers, the people and bodies making investment decisions. How do those relationships differ in different models, and what conflicts might they throw up? So we don't go in sort of with a presumption that there are particular conflicts of high concern, but we want to understand the models and then reflect on where the conflicts might be and understand how the relevant players are identifying those conflicts and managing them.
I think that point about the variety of operating models is particularly important, because when I mean, most SMAs are more or less of a type. You've got a platform, you've got an RE, got a portfolio manager, you've got an advice license. So they tend to follow a similar sort of structure, not universally, but generally. Much more variety in the MDA space, where you get specific relief for MDA on regulated platform, you get platforms that are MDAs, you get custody structures, you get, just there's a lot more variety in that.
Look, we're conscious of that, but even in the SMA space, I mean, I think in other areas of our work, you sometimes start looking at a sector or subsector, and the initial view will be, oh, it's relatively homogenous, but the more you dig, the more you find differences, and sometimes those differences can be quite significant, just in terms of the issues they throw up, and particularly around that issue of conflicts. And I think one of the things we'll be keen to understand is what are the fee and revenue structures and flows, like who is capturing value in the value chain, and what impact does that have on the ultimate outcomes for the clients?
Yes. So well, let's talk about outcomes for consumers, or we call them clients or investors, but outcomes for consumers. Throwback to your choice days. So outcomes for consumers, outcomes for investors, compared to what?
Yeah, I mean, it is, it's a really good question. It's a challenging one we have to grapple with in a lot of our surveillance work. I would say, and it typically comes up when we request a sample of client files and review them for compliance with those key obligations I've talked about. And that's something we may or may not do as part of this project. We're still settling the detail of the methodology. But I think one thing we don't do is try to review investment decisions with the benefit of hindsight. We're very clear in our regulatory guide that that's not something we seek to do, to sort of say, well, that product performed badly, so that means it was necessarily bad advice, and draw conclusions about the outcomes because of that. Where we're much more interested is where there are clear signals around client detriment, and you'll see that that's a term that we use in some of our surveillance reports, and we explain what that means. And so some examples would be where the recommendations don't appear to be aligned with the relevant circumstances of the client, and to get more tangible, where there are product switching recommendations with significant negative tax implications for the client, and they don't appear to have been adequately considered, or where there are significant upfront and or ongoing fees as a result of product switch recommendations that don't appear to have been adequately considered. So it's much easier for us to, and fairer, I would say, for us to assess in those projects consumer outcomes through a sort of negative lens, where there are clear markers around some of those forms of detriment in the information on the file.
Can I suggest that one of the subtleties that might be overlooked in that process, in thinking about those three instances you've just cited, or three considerations you've just cited. I mean, managed accounts are essentially a process-driven recommendation. And the counterfactual in a lot of cases is, I'm an advisor, my licensee has given me an approved product list. That approved product list might come with a model portfolio, or I might have my own views as to what a model, as to what a portfolio might look like. So there may be no financial considerations at all, no money changing hands, so to speak, between the two processes. But one produces a scenario where the client's portfolio is subject to continuous review and monitoring by someone we assume is appropriately equipped to do that. The other is, here's 10 funds, see you in a year, hope it goes well. I'm exaggerating for effect. So we're actually considering the sort of counterfactual of process, not necessarily the counterfactual of cost or self-interest.
Yeah, and that is obviously a much harder thing for us to assess, like the actual outcomes from that. So, but I mean, there's a reason we look at costs, because it is key to the ultimate financial outcomes for people. It's very tangible, and we think it is a fair reference point. So yeah, there's a reason why it's always important in our work.
Yeah. As a matter of interest, we are at IMAP precisely to try and address this issue, undertaking a study with the University of Sydney, which I hope will be funded through the Australian Research Council, precisely to take anonymised cohorts of clients who are ostensibly the same risk profile, but have been through the advised process or the managed process, if I can sort of separate it that way, and see whether, in fact, across those cohorts, there are in fact different outcomes. More reliability, less downside risk, less volatility, better absolute returns, whatever better might mean in this case.
Yeah, and I think if you're able to get that funding, I think that'll be a really interesting piece of research for us to watch as well.
Yeah, I think it's absolutely central to being able to say managed accounts work because clients get a better outcome. Look, are there questions from the floor for the Commissioner? We've got a couple of roving mics. Stephen's got one up there. Yeah, Jenny, yeah. Perhaps in this context, if you say who you are and the organisation that you represent. We're not normally that formal.
I know many faces in the room, but yes, that is handy. Thanks.
Hi, thanks, Alan. I'm a compliance specialist, and I also sit on the IMAP regulatory committee. And I suppose in this context, with the surveillance that's going to operate, there will be some members in the room who've gone through that process, and there will probably be a number that haven't, and so it can be a bit daunting. How are you, I mean, and I accept that you said the scoping paper is still there, but are you, have you got a target in the industry that you're looking at, and sort of looking at whether it's the managed account providers or whether it's the advisors? You've talked a lot about the advice process, whereas there's a bit of a mixed group in this room. Can you give us a bit of insight as to what that's looking like at the moment?
Yeah, it's a bit too early to say, although we're having some early engagement with a few key licensees just to sort of, in a way, test our thinking and pilot the approaches to data that we want to gather. So this is something we typically do because before we reach the stage of settling the overall methodology and the sample that we want to include and start issuing legal notices for provision of information, we want to check that that is pragmatic and likely to be useful to us. So that's the stage we're at, is just having some of that initial engagement with a few licensees, and then soon we'll be settling the methodology in more detail and reaching out to those that we want to include.
Okay. And timing. So we've got the 25-26 window, which is rapidly closing. And also we've got the MDA instrument, which is due to roll, and the reg guide as well. So is that sort of being taken in context with this scoping paper, so that, you know, the outcomes can also be rolled into that regulation?
Yeah, so I think in reality, this is a fairly big project, so it's going to take us some time. So I can't say at this stage whether we'd have a report out by the time that instrument expires. But I think in reality, we're going to need to start the consultation process on renewing that instrument earlier. And so what we'll be doing is then, as we're starting to land observations as a result of this surveillance that are relevant to the instrument, we'll bring them into that thinking. But the process will effectively move in parallel, I guess is what I'm saying. We haven't got enough time to sort of do it sequentially.
Yeah. We, within IMAP, we do actually have a working group of those who are particularly interested in the fact that the MDA instrument is going to be rolled, and engaging with ASIC with lots of helpful suggestions.
And look, I would anticipate at this stage our thinking on the review of the instrument is to put out a consultation paper, run that sort of process. We'll take on board your comments around time frame, but it's that sort of standard consultation process. We'll put something out asking some questions and welcome engagement on that.
Are there other questions for the Commissioner? Yeah, Tim.
Hi, Tim Farrelly, Delta Portfolios, asset consulting. So sit on a lot of investment committees. The observation, which is picking up on Toby's point, is I've been doing this for 25 years. The quality of decision making when people get around on a committee doing managed account is vastly better than the old way, vastly better. And my kind of plea is, as you get through this, because it's a big, fast-growing area, please don't make it harder for people to do things right than do it the old way. In other words, make sure whatever comes through doesn't say, oh, geez, it's just easier doing it the old way. And so still encourage people to go down the direction, but do it right, or encourage them to do it right.
And look, I mean, I don't think we'll do either of those things in a sense. I think we're agnostic to the models that people want to offer. So we just look at sort of compliance with the law. But I think what I would imagine us doing when we get to the stage of completing this surveillance and issuing a report is, and ideally we would have found examples of good practices. It's possible we'll find some that are of concern to us, but what we try and lay out is that spectrum. So as we work our way through themes in those reports, we'll typically say, here are some things that we saw as, here's the obligation, here are some practices that raise concerns for us, and here's some examples that we thought were examples of better practice. So hopefully that then, for people that can identify themselves or really similar practices in their better practices, hopefully that gives you some heart around the model and processes that you've adopted.
It is, if I can make one observation specific to the MDAs, I mean, for example, and ASIC's interpretation of compliance with the law, when the instrument was rolled last time, and I was involved, so I remember in 2016, there's a bit of the law which says an MDA provider should have no reason to believe that the advice provided by an external MDA advisor is not appropriate. Those are the words of the law. ASIC's interpretation of that in 2016, but not previously, was, well, that means you've got to read every SOA. So you may not necessarily be licensed to provide personal advice, but you've got to audit the work of somebody who is. It's a bit of it. So that was a sort of ASIC interpretation of the law, in a way which just added, a couple of $100 of cost for every client. So to Tim's exact point, we've got to be careful that we don't end up with a sort of regulatory overlay that makes it more difficult to do the right thing.
Yeah, and I'm not across the detail of that issue, but look, on that or any other issue, as always, we're all ears once we get to the consultation process.
Yes. Other questions, please, Carl. Yeah, Carl de Cruz, advisor.
Extending on the obligations of the individual advisor, is it fair if an advisor working for a licensee gets from the licensee managed account or any other projections as far as what investments to be offered to the client, and as long as it fits within the prerogatives of the client in as much as what they said, what they want and what they don't do, sometime later, if some of those investments don't quite work out, is it fair that the advisor is the one, because he's got responsibility for what advice he or she gives, be the person to be responsible for that, as against saying, I trusted the licensee to give me the right, and the licensee was giving the right advice, but circumstances in between may have come in. I mean, unusual circumstances like whatever, GFCs and whatever. Is it right to be holding the advisor responsible in a situation like that?
Well, I mean, the law's clear that the advisor has individual responsibilities, but I mean, just to respond to some of the premise to your question, I mean, when we're looking at compliance with the law, we look at it based on the information at the time that the advice was provided. So as I said, we don't assess that with the benefit of hindsight as, informed by market conditions that might have had an impact on how the investments recommended ultimately performed. So it's looking at the information available at the time, both in relation to the relevant circumstances of the client and the recommendations being made, and were they appropriate in the best interest of the client and prioritising the client's interests over the advisor. Yeah, I mean, it is a legal reality that the advisor does carry that individual responsibility alongside the obligations of the licensee and anybody else that's got an AFSL that's playing a role in the process.
Other questions? Yes, just there, Ginny. Lucy.
Thank you for coming along today. I know that success fees under 181 is frowned upon, but what's the difference then between somebody running an MDA with a very, very low actual admin fee, but has a success fee versus somebody who has a much higher admin fee and no success fee?
Well, there's no straightforward answer to that, but sorry, I just missed the first part of your question, but it was about success fees under RG 181, was it? Yeah. Look, I mean, RG 181, and the core obligation there is the obligation to manage conflicts of interest. I mean, the law, section 912A, doesn't say you can't have conflicts of interest. If anything, it acknowledges that they may be a reality. What's important is how they're identified and managed. So it is really that process of actively turning your mind to what might the conflicts be from a particular model, how are those conflicts being identified, and what management places are in play, what management processes are in place to ensure that you can still comply with the other general obligations. So it really is about that sort of process of how you're actually thinking about and responding to conflicts rather than whether or not they exist.
One final question. Yes. Just a microphone. Yeah. Perhaps if you just confirm who you are and where you.
Camilla from CFS. Thanks very much for your presentation today. With regards to conflicts, just wondering if you had any thoughts or insights that you could share with regards to managed accounts, specifically as one of their underlying holdings, having an in-house managed fund.
So unfortunately, my answer is going to be very similar to the last one. I mean, it's not, we don't have particular views on particular models. It is just that process that you must go through of thinking about what are the particular conflicts that come up in the context of our model and how are we identifying, assessing and managing them. So it's really, in a way, the ball's in your court. If you can demonstrate that you have worked through that process and that it's something that you come back to over time and reconsider in the context of any changes in your model or any risks that might be thrown up through data that you're getting, then you'll be in a much better position to demonstrate compliance.
I think these questions seem to me, this is my sort of closing comment, that they seem to me to highlight the tension that exists naturally in a managed account world, where you turn around and say, we essentially have a unique client with a unique set of circumstances, and what we're trying to do is meet those in as personalised a way as possible, given the given our obligations to behave in a systematic, process managed way. And so what we're trying to do is tie together, uniqueness at the client level, with a really pretty unwieldy institutional framework of platforms, fund managers, portfolio managers, and so enable everybody to do the thing they set out, the thing they are uniquely equipped to do that in an efficient, honest, and fair way, all the way down the chain. And so to translate sort of what starts off as being very generalized views of markets and securities, translate that into something which is unique to a client, and do that in a way which reflects a particular investment philosophy or orientation. And that inevitably is what's creating the tension within this chain. But actually, properly managed client outcomes are much better than doing this in sort of everybody doing their thing in a unique room and throwing what they do onto the next guy.
Yeah, and look, I think it's a fair observation, but I would also say it's that tension between sort of individualized kind of assistance and outcomes versus operating with the system is one that operates in many other parts of the financial system as well. So
yeah. Look, please join with me in thanking Commissioner Kirkland for his time today. Thank you very much for your time today in joining us. I hope you found the sessions worthwhile. We welcome your feedback on those things which we might do that would make this more relevant. As I mentioned at the start, looking into 2026, the things that we just spoke about seem to me to be one of the major strategic things that as a community we will be thinking about during 2026, and IMAP's aiming to do its bit to facilitate good outcomes both for us and for the investors. So thanks very much for your time today. Thank you, of course, to those, particularly Colonial, who have made today possible. And we look forward to you joining us again at our next event, which I think is the FAAA in Perth. All right, thanks very much.